Good evening, ladies and gentlemen. A very warm welcome to the HDFC Mutual Fund presents Moneycontrol Mutual Fund Summit 2025, which is powered by Axis Mutual Fund. Let's start this evening with some energy, and can we have a big round of applause before we start off this event? All right, today we are meeting at a truly transformational moment for India's mutual fund industry, one that's breaking records, setting new milestones, and reaching deeper into the heart of Bharat. So tonight is not just the evening for numbers and NAVs. We are bringing together some of the brightest minds in the industry to discuss how purpose-driven strategies, next-gen products, and the power of technology are redefining wealth creation in India. In a world that's going digital at a lightning speed, the question isn't if investing will evolve, it's how we shape that evolution together. And what better place to host this second chapter of our summit than the city of Bengaluru, the city that lives and breathes innovation, technology, and the bold ideas. So it definitely perfectly captures the spirit of our theme this year, that is your mutual funds unbound, purpose, products, and power of technology. But before we move forward with the conversation, we'd like to extend our heartfelt gratitude to our like-minded partners whose belief in this vision has made the Mutual Fund Summit possible. A special thanks to our presenting partner, HDFC Mutual Fund, powered by partner, Axis Mutual Fund, knowledge partner, KFin Technologies, associate partner, Reliance Industries, and event partner, Mirae Asset Mutual Fund, and Motilal Oswal Mutual Fund. And now to officially set the tone for an evening packed with insights, ideas, and inspiration, please join me in welcoming Dr. Nalin Mehta, Managing Editor of Moneycontrol and Chief AI Officer, Editorial Operations at Network 18.
Thanks very much, Lavisha. Good evening, ladies and gentlemen. The mutual fund industry is at the heart of India's retail investor boom, and I'm delighted to welcome you all to the 5th edition of the Moneycontrol Mutual Fund, the Moneycontrol Mutual Fund Summit, and the first one here in Bengaluru. Now, at a time when India has become the world's 4th largest economy, this year's summit theme of mutual funds unbound, purpose, products, and the power of technology seeks to unlock solutions in an era of AI and tech-enabled transformation, looking for answers on how to scale up the industry from its current size of about 75.61 trillion rupees of assets under management to its next big milestone and its next phase of growth. As the first choice for wealth creation for millions of investors, mutual funds occupy an exalted space in India's financial landscape. With India now looking to reach its goal of Viksit Bharat by 2047, the mutual fund industry's role, therefore, is absolutely critical for wealth creation, for financial democratization, and for investor consciousness. The numbers show how quickly Bharat's mutual fund industry has transformed India's personal finance story, turning us into a global mutual fund powerhouse. With over 77 lakh crore rupees of average assets under management today, compared to 11.87 lakh crore in 2015, the mutual fund industry has grown at a CAGR of over 20% in the last 10 years, about 24% in the last 5. So for comparison, the US mutual fund market grew by just about 8% in the last 10 years, although it's of course a much bigger market. We had a record of 29,361 crores worth of SIPs coming in last month in September 2025. And we now have over 9.2 crore SIP accounts and about 5.7 crore investors. That's about 19% more than last year. Also, the geography of India's investing is now changing drastically, as all of you know, with just about 1/5 of assets under management now coming from B30 cities. Going beyond the traditional centers, we are seeing huge growth of SIPs from states like Haryana, states like Uttar Pradesh and Odisha. When we look at India's cities outside of the top 5, 86 out of 104 cities have been growing faster than the national average. These are cities like Patna, Bilaspur, Gwalior, Thrissur, Ajmer. These are among the ones which are growing the fastest. Now, these numbers are a resounding vote of confidence in the mutual fund industry, but they're also not just a validation of the mutual fund story, they're also a blessing. They mean that we now have a deepening pool of household savings that can power capital formation, support private enterprise and fuel India's investment-driven growth. But also, there are big challenges to reflect on, and I hope some of those challenges will be reflected upon here in this forum. For example, the investor base may have hugely expanded, but only about 6 to 7% of Indians currently invest in mutual funds, compared to, say, about 50% of Americans. As the new generation of Indians becomes first-time investors and the industry scales up, there are some very important issues to reflect on. How do we build more trust in the system? How do you use technology to increase accessibility without compromising on transparency? How do we increase investor literacy so that every Indian understands the value of compounding, of risk, and of patience? Our panels today explore all of these themes and much more. And as we deliberate a blueprint for mutual funds growth in the time of AI and uncertainty, in the room today we have some of the industry's best minds, our leading fund managers, investors, distributors, and policymakers to deliberate on what next and how to unlock the next phase of investor growth for Bharat. From quant-based investment models to AI-based advisory, there is now an all-new opportunity to power the mutual fund industry forward. But we need to do so responsibly, because this is about our nation's saving pool and what will power our economic growth in the coming years. Tracking mutual funds and their trajectory, of course, is central to what we do at Moneycontrol, which is India's leading business and markets news platform. With over 100 million unique monthly visitors in 2024 and over 1 million paying subscribers, we strive to provide information that can help our readers make better investment decisions. This is why we are proud to have created this premier platform for key stakeholders in the mutual fund industry to come together and to shape the industry's agenda for the future, to deliberate on key issues, and to spark off meaningful conversations, new connections, novel solutions, and long-term engagements that matter for Bharat. Thank you.
Ladies and gentlemen.
Thank you, Nalin, for that inspiring start. And let's keep this energy going as we delve into our first conversation of the evening. Well, the mutual fund industry, as we all know, never stands still. It's constantly evolving, adapting, and forging ahead. But here's the big question. What new investment avenues are opening up for investors today, and how can these opportunities help align portfolios with financial goals and aspirations of billions plus people in this country? One brand new category that has just opened up for fund investors is Specialized Investment Funds, or SIFs. With this sophisticated product, which uses derivative strategies available only to rich investors, mutual fund investors now have the access to the sharper product innovation with a stronger sense of purpose. And to take us through this fascinating discussion, please welcome N. Mahalakshmi, Senior Editor of Moneycontrol. Please put your hands together. And joining her on this power-packed panel are two distinguished leaders who are leading this category with their new launches in the space. Mr. D.P. Singh, Deputy Managing Director and Joint CEO of SBI Mutual Fund, and Mr. Sandeep Tandon, Founder and CIO of Quant Group. Please welcome them with a big round of applause.
Good evening, everyone. I'm absolutely delighted to kickstart today's sessions with this panel. Anything new is always exciting, but in the context of mutual funds, every time there is a new fund launch, it's reason to be slightly cautious, if not skeptical. But this is a whole new category. But this whole new category, I initially, termed this panel as the SIF challenge, which Sandeep promptly corrected and say, let's call it SIF opportunity. So it is definitely an opportunity, something that a strategy which has an entire industry based on this strategy, the AIF Cat 3 funds. And now this product construct is open to mutual funds. So here is this elephant in industry that now takes over this category. Is it going to truly take over this category? How big how big an opportunity is it for the industry? What does it mean for the investors? Let's sort of start this conversation. And I couldn't have thought of anybody better. First of all, the two gentlemen here are the front runners in the SIF launch. And the more remarkable thing is we have on this panel the biggest industry leader. SBI is the biggest mutual fund company. And Quant, which is the fastest growing mutual fund company in the last 5 years. So a big round of applause for the two gentlemen and the strides they've taken in opening up this category. So let me start with you, Mr. Singh. How big is this SIF opportunity itself? In your mind, have you gauged what this can do to your company in the next 1 year, 3 years? Do you think the 3 lakh crore that sits today in AIF Cat 3 will be in your kitty?
First of all, Mahalakshmi, thank you very much for all the good words you said about it. And SIF, I think I'll take 2 minutes to explain the background, how this SIF as a category was born. You know, our earlier SEBI chairperson, madam, when she noticed that a lot of money is, when the mutual fund investors, when they evolved, they were going more and more, they were going into the PMS and AIFs, which were little lightly, loosely regulated. But she was worried that the regulations which are there, because the definition of a smaller investor and bigger investor changes with the prosperity level. And today when we are sitting, and earlier we were saying 5 lakh plus is an HNI, today even 10 lakh plus is being called as the retail investor. So this has been the journey, and she always wanted that she should be regulated, so that people should not go just because of the remuneration to the intermediaries, because the regulations were light. So all this process of consultation, everything happened. This SIF category was born in, where the evolved investors were allowed to put in money, where they can use derivatives, where they can use all the modern, whatever tools are there, those can be used for their benefit. So first of all, thanks to madam, and thanks to that thought process, progressive thought process, that SIF as a category was born. And when it came, and then we know that the way the industry is growing, the way the evolved investors are growing. So this is something between loosely regulated so-called AIFs and PMS and the mutual fund. So in between they said, okay, this will be on the mutual fund platform, but this will be a different category. You can't sell it like mutual fund. There are guardrails which have been provided so that nobody missells it. So that's the way, but now coming back to your specific question, I think it's a matter of time only. This is going to be a very, very big category. And we as leaders, when we went through the papers, when we went through the circulars, we thought it's our paramount responsibility to start with this. We will not wait for others, or congratulations to Sandeep and other Edelweiss also, they have done it. They are the small players, but we as leaders, we thought it has to go to the larger. So though we took baby steps, we were having very limited targeting for this. But we said we will start with the most conservative, that is the hybrid category, then move forward. But we have done internal study. We clearly feel that within 1 year from here on, it should be a 100,000 crore category. That is our number.
Wow, that's like 1/3 of the current AIF PMS category 3 structure. Sandeep.
So, Mahalakshmi, let's understand the background. Okay, now as we are getting aligned towards global markets also, we are talking about $10 trillion economy. Globally, this wealth preservation product have evolved, whether you call it market neutral, beta neutral, absolute return, various names you can talk about, okay, long short or low walls. I think this type of product will gain traction in India. And we as a house is also very excited about it, because in fact, what Mr. Singh was also describing, we actually should be grateful to SEBI, what they have done. They have created a very innovative product, and with a huge tax efficiency, okay, transparency of mutual funds. So I think this product will shape up quite well. And I call it, this regulator has given us a important weapon sort of thing. It's up to us how we want to use it. Whether we want to use it in a very aggressive manner or we want to use it in a conservative manner. The way all three products have come, it looks like industry is using as a conservative approach. So the way I look at this product has a potential when you talk about it can generate superior risk adjusted returns. And hence, if I have to take a very big call in next 10 years, I think it has a potential to be 40-50% of the active mutual fund equity product. That's a potential which I see based on the global trend, what we have seen in this market, which means a very
Derivatives has this perception. People have this perception about derivatives, which is, perpetrated for many, many years from this quote where Warren Buffett famously said that derivatives are weapons of mass destruction. And over the last 3 years, SEBI has also continuously sort of, presented its studies saying that people only lose money in derivatives. So the perception of derivatives or any derivatives links product to an average investor sounds like it is more risk, you can lose money, not less risk. Now, how do you market or message this whole concept to an average investor? And what do you tell them about what is the purpose this fund is going to serve?
See, first thing first, as you rightly said, that Warren Buffett has said that this is the tool for the mass destruction of wealth. That's right, because the people who are using it generally are going by greed, going by their gut feel, not by the research and all those things. But when the serious fund houses like ours, we here, so we do it in a very, very, very balanced manner. We use put and call simultaneously. We don't have to take the naked position. We see how much carry is there, what is the policy interest rate, and how much this can, if we use the put and call and we do the back testing. All those things are done so that, as Sandeep rightly said, idea is not to give the very, very high super duper returns, but to give returns which are better than your policy rate, 200, 300 basis points. And when we looked at the especially why the reason why everybody came with the conservative plan, only because of the reason that it was visible that when we are starting a new category, people should have a good experience. For that, we are confident that we should be able to walk the talk. When we said something that this is possible, we did our own internal studies, and for that matter, others also would have done it. We are not going to go, this is likely to give this. Likely is nothing, but we have to go by what premium is there, what discount is there. We don't have to keep naked position. Now, we are saying we will not keep the naked position more than 10% of the fund, right? So that will, create a situation. The 10% we have said we may not do even 10%, we may be 0%. And it's like a arbitrage plus kind of return. We'll start with this, and by the time we also gain experience, we'll be able to give better return. We are not using the derivative which is generally said, because when SEBI gives the data, because on the basis of how the retail investors are doing it. Even mutual funds are using derivatives as a product, and they are using it to hedge the risk, right? They're already doing it.
Hardly any, except for I think 2 or 3 funds. People don't. Most of the fund managers
I can talk about ourselves. We are doing it. We were not doing it, but for the last 2-3 years, we are doing it quite aggressively, and we are using it as a to hold the downward risk for the funds. And again, this is a matter of experience, right? The more and more you get experience, the more you will be able to do it. As I said, we took baby steps. To start with conservative, to start with this thing, as and when when we ourselves have more experience, we'll be able to do it. And there are so many players who might not have done launched the fund, but they are experts. And actually sitting here, they are using it very extensively in their day-to-day working, right?
So today, who is your target audience? Who are you selling this product to? And what is the message?
The target audience says that we see one downward risk is very limited. We are trying to give with the mutual fund kind of equity taxation. If we are able to give 100 to 200 basis point on the minimum side, then our any fixed income coupon product, that should be a good fund. Our target is somewhere to generate a return of somewhere between 8.5% to 12%, which on the back testing basis looks feasible. But then it's a matter of size also. How much is the juice available and how much the tools are available? But at least up to a particular level in the market, enough 100,000 crore will be the amount which can be easily sustained in this kind of category as of now. But when more players come, more liquidity comes, then things will change. But we are very sure with the kind of expertise we have, in-house we have got a strong team and everybody has a strong research team, we should be able to generate good wealth for the customer. We are very, very confident about it.
Right. Sandeep, the point I was trying to recollect.
I want to add one point here. So when we're talking about perception about derivatives, and this famous quote comes from Warren Buffett, this is derivatives are instrument of mass destruction, the fact remains that he is the biggest user of derivatives globally because they run the insurance business. The point which I am trying to make, derivative instruments are used for controlling the risk. SEBI is not allowing us to use as a leverage tool. As an individual, you can increase your leverage exposure through derivative routes. Like if you understand what the regulation, what SEBI is saying that at any given time, your gross exposure in the market should not exceed 100%. What it means, if I have taken 100 rupees long and let's say I'm 100% invested, now I have to excise this 25% naked short option or unhedged option, what we call it. It means first we have to cut down our gross long exposure to 75% and then 25 makes it 100. Effectively what it means, I have cut down my net long exposure to 50%. Effectively I've cut down my beta by half, okay, broadly, not exactly mathematically, but broadly we have cut down. And hence these products are better beta management product, which means superior risk adjusted return. You are able to control at least some dimension of your risk. Risk has multi-dimension. At least few important dimension of the risk you can control. So perception can be very negative for derivatives, but the frank reminder, it is a risk management tool.
True that. So now, there is this perception that in a long short strategy, on the way up, when the market goes up, you make money on the long. If the market goes down, you short and you make money. But since the gross exposure is anyway capped at 100%, whoever I speak to, they seem to be very gung-ho that, a wrong short strategy to matlab badhiya hi karega, matlab index se better karega. While theoretically, it is like an equity minus kind of return. And so one, what is your view on this? How do you sort of, drive this message? What is your own view on where will this product, what will this product deliver vis-a-vis the index? Please tell me that and then I'll ask you a related question.
So it's an interesting question actually. Let's understand when we talk about derivative instrument or any product which we're talking about, obviously it's up to the capability of money manager and how well he or she utilize the inflection points, okay? So effectively, let's say talk about a flexi cap as a product, and we have just launched one of the first product was the flexi cap thing. So here you are getting an additional option of shorting of 25%, means you can generate alpha out of. There's no certainty that you will generate alpha. You can lose also. So the way I look at it, that if you run it aggressively, then you will be generating plus minus 3%. The cycle is in your favor, plus minus 5 also can happen. But we as a house have taken a conscious call running in a conservative manner, and it is our endeavor to generate small alpha over your equity scheme with limited risk. So obviously when you have to talk about, when you want to control your risk, then which means you're also going to compromise on your return expectation. That aspect should be very kept clearly. Theoretically speaking and real life, you can generate extraordinary alpha also through this product, but risk aspect also have to be kept in mind.
So you said that this is a product which gives you a little more than an income fund, right? A fixed income product. You already have the arbitrage fund, which is for the industry now a sizable corpus also. What does this, will it kill the arbitrage fund category? If everybody is assured that they're going to make 100%, 100 bips more than an arbitrage fund, and significantly more than, 200, 300 bips more than an fixed income product, what is the real advantage in deploying in arbitrage funds at all? Are we creating a category and killing another category?
No, it's not that. If you look at the arbitrage returns, it's somewhere around today. It is giving around 5 to 6% kind of returns as we move up, and we are saying there's some product which is. You just take the example. If you go back 10 years back, there used to be 7%, 7.5% tax-free bonds of RBI. Okay, those were the fixed return, and people are standing in queues to buy that. If we are able to walk the talk, that's why I said we have taken baby steps. We are confident, theoretically. But practically, if we are able to do it, we have to make it very, very big. We have to walk the talk in a manner that all the expertise is to be used. Just to give you an example, we have got a 5-member team. Every day they have to see whatever we are talking about is being implemented. If we master that, if we are able to do that, today with our kind of network, had we taken a target of this thing and just giving a narrative, we could have collected much more than we have collected today. But we said not more than this amount, let's do it. It's not the experimentation. Downside is very, very limited. We are saying 8.5% to 9% to 11, 12%. Even if it goes down, it will definitely be arbitrage plus. But let's work on it. This is something new animal in the table. We have to work very hard on this. And honestly speaking, as Sandeep said, there's a huge alpha generation capability, but that comes with the risk. We have to mitigate the risk. We have to see we don't take extraordinary risk when we are coming out with the hybrid fund. We have to make sure how we can use our expertise to make this thing. Now, at this point of time, I think we should just let the things mature. Let's see how it happens. But one thing is very clear, capital protection, arbitrage kind of terms are the minimum thing which we can think of.
No, so will this, you think this product can coexist with the arbitrage category?
100% it can coexist. Because today arbitrage funds I mean, majority of the money is the liquid category which has moved to the arbitrage category. But this is a fund which is mainly whatever we have collected or whatever Sandeep would have collected or whatever others have collected, all these people are 10 lakh, 20 lakh rupees applications. We have not got 100 crore or 200 crore. Whereas the arbitrage, we are getting that kind of money. Right. Okay, this is more stable. It can give us some time to work on it. We are not going to ask the institutions to park 50 crores or 100 crores or 200 crores or 500 crores. That's not going to happen. Right. That's not the target. Target audience is the people who want stable return with the tax efficiency. And thanks to regulator, this was not there. This has come now. We'll try to see how we can create wealth and create value for the customers. Right. That is the basic, the premise on which it has been launched.
Right. Sandeep, you said during the course of the conversation that over the next 10 years, you think this product can actually do better than an actively managed equity product.
So I think if we are in a risk-off phase, which looks like that India easy phase of bull run is over and we are in difficult phase of bull run. In difficult phase of bull run, this type of product will logically generate superior risk-adjusted return. I will not say it will generate extraordinary return, but here you are controlling your beta, so obviously your risk-adjusted return will be far superior.
But in comparison to an index fund, where do you think this will be?
So again, it depends how we want to run it. If you want to run it in an aggressive manner, then you are also running a risk. So I said plus minus 3% you can make. But if you're running in a conservative manner, then possibility is there. The way we are going to manage, then we will generate maybe 100 bips, 200 bips higher than the normal returns. So let's say we're talking about flexi. So we are talking about flexi plus long short opportunity. When we're talking about quant hybrid fund, we are saying BAF plus long short opportunity. So the people understand those terminology, and accordingly we are positioning that product. This additional 25% option, or the flexibility which we are getting, we want to generate alpha also, and we want to protect. See, in mutual fund also you can protect by hedging. So anyway, mutual fund hedging is anyway allowed. What is not allowed is that about the shorting option, that are true naked shorts are not there. Sometimes you do get opportunity. Okay, again, it's very easy to talk theoretically, but real life, when you manage, it is going to be challenging.
No, coming back to the same question, because you're saying BAF plus long short, you're saying flexi cap plus long short. But plus long short is mine in terms of returns, because most investors are still guided by returns. So they'll say this category, for example, it's easy to argue that over a long period, small cap funds will do better than large cap funds. This is a narrative. If you look at very long periods, it's probably not true. If you look at like 20-year period, the returns are pretty much the same. But in the minds of investors, it is still that is the return better than index fund or a flexi cap fund or a large cap fund or a small cap fund? So where do you fix that? What is the position?
So that's the reason I said plus minus. I never say only plus.
Plus and minus.
Plus minus 3%. I never said only plus.
Right.
But idea is that if you're getting a shorting opportunity and if you can identify these inflection points, you can generate. Okay. And if you run it the way we have decided, we'll run in a conservative manner. So we remain confident that we can generate a positive return. That's our endeavor and it's possible. Backtesting also, model also showcase that is a question how you run it. The moment you try to run in an aggressive manner, then you run a bigger risk.
Sure. Sir, all the money that you have collected so far and the 1 lakh crore that you are saying we should be able to augment in the next 1 year, is this money that was earlier deployed in AIFs that is coming into fund structure now because you have a tax advantage for the product itself, right? Like the churn within a mutual fund space is not taxable. In AIF, they are disadvantaged. Is it that arbitrage opportunity that investors are exploiting? Or do you think these are new investors who are like, between the 10 lakh to 50 lakh or 1 crore category, that's the cohort of investors they're looking at?
See, so you have to understand, we have a huge opportunity potential is untapped. The number of customers, total numbers, I was talking about the number of SIPs, etc. But the unique investors are still hovering around 5 to 6 crores, right? The new investors, the new niche investors, mutual funds per se is no more a push product. People are, now it's only the intermediary or the manufacturer or the institution who is reaching out to the new customers. When new narratives come, new set of customers also come. That is for sure. And that we have seen whenever we launch an NFO, almost 30 to 40% of the customers are those which are new to the industry. Even in this SIF, though numbers is very small, it's not representative number, still we had 20-25% which are the new investors, new to the industry, new to the mutual fund. And they straightway came to SIF because of the narrative being talked about in the market. So more and more number of customers will come. There will be an opportunity for each category of funds. As Sandeep is talking about, there are people who want to be very conservative, people who want to take much higher risk. The surplus money with the investors is growing, and especially if you talk about millennials or Gen Z, they have already been taking so much risk in the direct derivative products. That's what is SEBI is talking about. If you look at the profile of the customers, most of them are less than 40 years of age, who have lost a lot of money. But if they get good experience through expertise with the regulated costing, regulated price, and they are losing less money, making more money, I think more and more customers will come. If you look at, there's a huge gap between the number of demat accounts and number of mutual fund accounts, right? It's less than half. So we have to get more people who have been using direct market through mutual fund route. And these are the interesting products which they will like to work on. I'm very confident that new set of customers will come in. This is the baby step we have taken. And going forward, it will be a very, very big category. And it's not that there's a trade-off that people, yes, there will be people who will move from mutual fund normal products to these products, but there will be much bigger number which will be entering into the mutual fund category.
Sure. Sandeep, one last question. The experience of long short strategies in, AIF category 3 so far has not been very good. So why is it that you believe that it will work in the mutual fund structure?
So whatever little bit of research we did, there are 3 reasons. First important reason is that the people who are managing, they all came from long accounts background, long mindset background. And when you manage long short, a very different perspective is required. That's the first issue. Second issue was the taxation. Third issue was the fee structure. So when you're going to pay upfront 2.5% or 2%, then it's not viable. So and then despite that you have leverage benefit was also there, 2 times leverage with their fund. Some of the schemes had delivered 12-13% returns. But the challenge was because of other 2 factors, their net returns was lower than the liquid fund returns. So it was not very effective. Here we are talking about tax efficiency and as well as the transparency of a mutual fund plus the cost structure. We're going to run like a normal mutual fund. So when you get a 50 bips sort of thing, then obviously things will be very different.
Sure. By this time next year, how many funds would you have and how much corpus do you expect in your fund?
Our objective is we are manufacturer. We will launch all the product. We think by December, all of our product will be launched. We are not in the debt side, both all hybrid and the equity going on, 2 more in pipeline. So by December, we think all 5 product will be there. It is too mature to talk about what will the corpus. That's not the way we operate also. Okay, we think as a manufacturer, we are offering product. I personally feel that it takes time gradually because a lot of people come and ask me, I said, just put 10 lakh rupees only. Experience this product. Once you experience it comparative to your mutual fund scheme, compared to AIF, this is a product which is a new category. Unless you experience, you feel it, you will not be able to understand the importance and then the traction will start. My personal sense is that initially 2-3 years, it will be a very slow process and maybe 3rd year onwards, it will start picking up when some traction is there.
Sure. Thank you so much. Kudos to both of you and all the very best for SIF and also for your AMCs over the next 1 year. Thank you so much, Mr. Singh. Thank you so much, Sandeep.
ML, requesting you to be on the stage. We'll have your next discussion as well. All right, thank you, Mr. Singh and Mr. Tandon, for that insightful conversation and discussion about SIF trends, and we'll be definitely watching out for this new product category in the upcoming days and months and years ahead as well. But yes, requesting ML to continue being on stage with us for the next discussion. The next discussion is going to be on the India's investment ecosystem, which is not just expanding more, it's accelerating onto the global stage. And right at the heart of this momentum stands the GIFT City, which is emerging as a true magnet for the global capital. With over 3,500 investors from more than 60 countries and commitments already crossing $22 billion, GIFT City is not just a financial hub, it's India's gateway to global investing. So what's fueling this phenomenal surge? What makes GIFT City such a strategic powerhouse for international investors? And how is it reshaping India's ambitions to stand tall as a world-class investment destination? So to decode this exciting growth story and share their perspectives, please join me in welcoming our distinguished guest to the stage, Mr. Vaibhav Shah, Head of Products, Business Strategy and International Business at Mirae Asset Investment Managers, Mr. Abhishek Tiwari, CEO of PGIM India Mutual Fund, and Mr. Neil Parekh, CEO of PPFR's Mutual Fund. Please welcome them with a huge round of applause.
Thank you so much, gentlemen, and thank you, Lavisha. So in the last 2-3 years, and definitely in the last 1 year, there has been so much heightened conversation about, activities at GIFT City. Everybody seems to be opening up offices. There seems to be a lot of excitement. Originally, the whole idea of GIFT City sounded like it was a place, destination where India could carve out a place where foreign funds could come and establish funds, and it would take away share from markets like Mauritius or any other destination, and funds could India could offer a destination that could rival these sort of markets. In the last 1 or 2 years, I think the conversation has also shifted in terms of how AMCs, local funds are saying that we will set up offices there, go and solicit money from overseas investors. And lately, mutual fund houses actually setting up shops there or launching funds there to manage local investors' money in overseas equities. So Vaibhav, let me start with you. Tell us what exactly is the deal with Gift City? What is the real opportunity? There are all these three opportunities. What is the real opportunity?
No, thanks for inviting me for this conference. So you're right, that Gift City was started with the idea of able to attract foreign capital into India. But when you want to compete with the likes of Singapore, Mauritius, Dubai, you can't have a financial jurisdiction which is able to attract only investments into India. You need a jurisdiction which can equally allow opportunities for resident investors to invest globally. So I think Gift City is now coming to the complete way of not only able to attract global capital into India, but allowing access for Indian residents to invest globally. So it gives you the opportunity for asset managers to showcase their entire product range, not only limiting to India, but all global products as well.
Abhishek, you have funds which actively managed funds, feeder funds that invest in equities. There is one cohort of investors in the mutual fund industry who want exposure to overseas, and it's been an ask with, fund. I think the industry has been talking to SEBI, and SEBI has been talking to RBI. There is a cap on overseas investments. But we don't see local investors really warming up, if I may say, or aggressively taking the route that you offer. PGIM offers 3 actively managed global funds. Why is that?
Okay, thank you for having me, Mahalakshmi, first of all. And I was actually a little inquisitive that I don't have a Gift City, but you still wanted me to on the panel, so I'm glad that I'm here.
Because that's the alternative,
But
right? Now
I got
that's
the point.
the alternative. Why is the alternative not working? Everybody wants to launch a fund out of Gift City, looking at a certain market. You have something that is right here. What is the difference? Why is it not working? Is this interest real? Is the optimism real?
Okay, so like every time, I'll try to get out some data which may possibly give you a little bit of a perspective. When you look at the home country bias, it actually exists across the world. And in fact, even for economies which have not produced capital market returns, the home country bias remains extremely high. So a case in point is Japan. The home country bias is 84% of the investment of domestic investors is in Japan. The most diversified household savings going into international investment comes from US, which is possibly to the tune of about 30%. I think it is not wrong for us to say that India is very much in its infancy. I don't think we have enough penetration. The other aspect is that Indian market itself has been very, very fertile. But having said that, I think in whatever limited time frame that you see global investing in India, I think we have been able to very respectfully garner decent amount of traction. It is always going to follow returns. There's no two ways about it. But having said that, I think if the tap was not to be closed, I think we were literally running on the 5th gear. So for that, I mean, I'm speaking on behalf of the industry. I think I see Akhil sitting here in Motilal. He can vouch for it. We can vouch for it. I think guys from Kotak can vouch for it, and so on and so forth. So I can safely tell you that there was enough work and enough interest. And I think that comes from the fact that when you think about not only the geographies, but also in terms of some of the themes which don't exist in India. Think about, I mean, I was just looking it up, and if you think about mobility as a theme, right? Mobility as a theme globally is growing at 38% compounded. Then not only the theme is itself growing slowly in India, but the outstanding size is so limited that if you want an exposure into that, you will have to go global. And this is just one, I mean, one very, very outsized example. There are tons and tons of other things, Mahalakshmi.
No, my question was not appetite for global. My question is the existing fund structure, which is the feeder fund structure. And I was quite amazed to know that your funds are, the expense ratio is 2.5%. Of course, it's double of what a normal active managed fund is. Nevertheless, not, I mean, 2.5%, I mean, lots of funds in US have that kind of expense structure.
So 2.5%, first of all, is the complete structure. It takes care of the underlying fund structure as well. And I think, I was trying to exactly answer
so
what
why
you
is
asked.
it that you're today not sitting on 5 lakh crore of AUM?
No, so I think one of the biggest reason is that when you speak to investors, and largely this has been a product which mid-net worth, high net worth family offices have liked. But when you see a scenario where you don't have visibility on the continuity of that tap in terms of regular allocations, people take a step back. But whenever, like for example, in the beginning of this year, not even the beginning, in fact, April of this year, when we reopened our funds, we had about 1,000 crore window. We are very much at the end of closing that window as well. So I think there is interest, Mahalakshmi. I think, as I said, the home country bias is always going to prevail. You buy what you understand. Otherwise, you buy what is performing. So you have to be cognizant of that.
Okay. Neil, how are you? I think your fund is coming up in the Gift City, right? How are you looking at this opportunity?
Yeah, so I think there's tremendous interest in global investing, and we've kind of done this for the last 15, 20 years now. In the mutual fund, obviously the tap is closed now with the 7 billion. So I think what people also want when they go to Gift City is also diversification of equity into different markets, but also diversification of the currency. So today when you are investing in a mutual fund, you're investing in rupees, getting in rupees. Today the need is also to invest in other currencies, and Gift City gives you that option to invest through different currencies, and people have different needs, education, building assets abroad and whatnot, So I think this opens the door. The other interesting thing that's happened there is retail funds. Now, before it was the minimum investments was 75,000 to 150,000 USD, and your LRS limits is 250,000. Today, we can launch retail funds out of Gift City, and that is the exciting part, that you can go as low as $5,000 and $10,000. And why this number is important is because TCS starts after 10 lakhs. So if you have a $5,000 or $10,000 kind of minimum, then you don't even need that 20% TCS that gets cut. So retail participation can be there. Onboarding has become much simpler now. It's almost digital. I think over time we'll get back to, we'll probably get where how easy it is for a mutual fund, how we onboard people in a mutual fund. I think in a few years' time, I think that will be the case with Gift City too. So very exciting times ahead.
Fair enough. How big do you think this Gift City retail interest can become?
So Mahalakshmi, I first want to just add to what Abhishek had mentioned. So if you see that we had launched a product called as NYSE FANG product. In a very, very short time, because the fund did exceedingly well, we saw huge participation from retail, from HNI investors, and it became the go-to product. In fact, over the last couple of years, some of our schemes on the equity side were not getting as much flows as we were getting on the FANG side. So, like Abhishek mentioned, it all boils down to performance. Whatever is performing does get lion's share of flows. And mutual fund industry gave you that opportunity of getting retail money, HNI money, in a very simple manner. In Gift City, like Neil mentioned, the advantage we will get is we will be able to get retail applications as well. But the only challenge remains that still everything has to be under the LRS window. And if you manage to launch retail funds within 10 lakhs ticket size or $10,000, 5,000, then TCS is not applicable. But LRS transfers are not as easy as investing through the mutual fund route. So it will require fair amount of education for retail to understand how LRS transfers happen. We've launched an outbound fund about 2 months back. We got a very good response because the fund has themes like semiconductor, AI, digital infrastructure, data centers, all within one portfolio, like Abhishek mentioned, which you can't get access in India. But the challenge which I found most of the investors faced was the ability to do transfers. So the banking system in Gift City is not as robust as we have the mutual fund payment system, where you could transfer money instantly. And once we can solve that, I think retail can become very, very large and can attract huge amount of capital through the Gift City route.
Fair enough. So how does this again rival with the feeder fund structure? Because whatever said and done, that category still exists. And if every AMC is going to sort of, exploit this, and the onboarding is going to be as simple as Neil and Weber were saying it is going to be, what happens to the feeder fund structures?
So one way to look at it is the feeder fund offers you an access into these underlying funds at practically 1,000 rupee SIP or a 500 rupee SIP and a 5,000 rupees lump sum. I don't think we are going to go down to that level. The other aspect is the ease of operations.
The investor who is investing in that fund is not a 1,000 rupee, 500 rupee investor, right?
We'll be actually surprised, Malakshmi, to a point that, see, our journey in international investing started, within PGIM, it started in 2018. And very much similar to what Vaibhav said, for us, before our equity journey started from 18 to 2020, the only fund that was growing for us was global equity. We had an SIP book to the tune of about 40 crores, and it was granular. So, I mean, as I said, and as Vaibhav kind of chimed in, what performs gets the money. And I think that's exactly what we saw. But having said that, coming back to your main question, if you were to think of it from a parallel, I think ease of operation, simplicity of not worrying about currency, because everybody doesn't understand all those transactions so easily, unless until there is education. I think there will always be a little bit of a benefit that the feeder fund structure would have if the tap was to open.
How do you see the currency risk in this product, Neil? Because one is always a little bit confused about where the rupee is headed, because for a good part after post-COVID, there was, in the first 3 years, people thought that, the trajectory will completely change. And instead of a depreciating currency over a period of time, not only will our fall be less, but we might start to appreciate. It's been anything but. In the last 1 year, it's, what has happened is instructive. All other currencies against the dollar have gained except for the Chinese currency and the Indian rupee. How do you see the currency risks, and what is the messaging to investors around this?
Sure, there's currency risk is going to be there. I mean, there's nothing anyone can do about it, and definitely not us. So for us as fund managers, as asset managers, main thing is to select stocks and invest the money properly. So currency risk will be there, but the main thing, like I said, was it's about the diversification. It's actually reducing the risk. So currency risk, though, might be there, but on your overall portfolio, when you're investing in different markets, you're actually reducing your portfolio risk. So that's what we are talking about, and yeah, currency risk is going to remain, and nothing you can kind of do anything about it, so just live with it, I guess.
Is that your message? Live with it?
So two things, Malakshmi. First is, when you invest globally, actually currency risk is actually in your favor.
Right now it's in our favor.
So if you feel that the rupee will depreciate, then global investing, you're already plus 2-3% to start with.
Yeah.
So you did not worry. So global investing will not only make sense because you start with an advantage there, but look at the last 10-15 years. India has been one of the best performing markets in local currency, but in dollar terms, Indian market has just generated about 8-9% returns, while the S&P 500 has delivered about 13-14%, Taiwan market about 12-13% in dollar terms. So there are enough markets which in dollar terms are able to do much better than India. And if you look at some of the themes in India, and I want to give references to maybe 3 or 4 themes that we are very bullish as a fund house, and we don't have investment space, is artificial intelligence, semiconductor, blockchain, and disruptive materials. If you were to look at these 4 themes, in India, you don't have maybe 5 listed companies in this space, in these 4 themes. So forget the currency part. If you want to have a universe of stocks which can give you exposure to such large themes, which can become very large in 5-10 years, it completely makes sense to invest globally and reduce your currency risk.
Right. Where do you think, Abhishek, the big money will go? The big investors will take I'm saying not ultra high net worth, but the high net worth will go through the Gift City route now, or would they prefer to take a rupee kind of bet?
I think it's straightforward, Mahalakshmi. That's the only tap which is open. Having said that, I think on the feeder fund, whatever I'm hearing on the industry and whatever we are experiencing personally, till the point the tap remains open and we can accept money, I think there is enough amount of interest that is getting generated. But having said that, while those numbers are not publicly available, at least the interest that I have seen in terms of HNIs, ultra HNIs, looking at Gift City as a constant medium of diversification, it is only getting increased.
No, I'm just asking from the currency perspective, where is, what is the Indian investor really looking for?
So one way to think about it, Mahalakshmi, is that if somebody is really looking at de-risking the whole currency aspect of it, Gift City doesn't provide you, 100% portability. You ultimately have to bring the money back unless and until you are going and establishing an OPI or ODI outside. For a normal retail investor, you will have to bring the money back. You are still mapped to a bank account here in India. So I don't think that's a solution that gets provided. That can be provided through a Cayman or a VCC structure in Singapore or things like that. At least that's my understanding. So I don't think, first of all, let me chime into what Vaibhav said. I don't think currency is the biggest variable here anyways. See, we manage global funds which are diversified and which have always been exposed to different geographies. So the equation is never going to be about India versus US or India versus Japan. It is about companies which are doing well and how they offset each other, in the whole game. So we have exposure in developed North America. We have exposure in, Poland, Italy. If you were to worry about currency, you will never go to Italy. But we have had one of our huge exposures in Italy, and which has made us money. So my way of looking at it is, if you buy the right businesses which are compounding faster, I think currency will take will take care of itself. Don't think that should worry. And I think between the two mediums, I don't think there's too much to choose.
Sure. So at the heart of all of this discussion, in the end, everything boils down to performance. And performance boils down to, what is your team structure, what are the competencies of the fund managers, and so on. Neil, so what is the, expertise that your AMC really brings to the table? Because unlike a foreign company can say that we already have teams and partners who are investing abroad, so we draw on their expertise. You are a homegrown India company. How have you set yourself up to succeed and perform in overseas markets?
Yeah, so I think our strong point, excuse me, our strong point is research, and we've been researching in-house foreign stocks for about 20 years since the financial crisis. We've been investing for our clients since 2010-11, and then in the mutual fund post that. So research is common between for the whole organization in terms of the research process and research sharing as such. So research is something that we are very confident about doing. Other than that, I think one thing that I think Gift City needs to probably get better at, or something that needs to improve, is the taxation part of it. So launching, you're taxed on your churn. So every sell decision, if you launch a fund out of Gift City, is taxed, and which is not very efficient. So I think what we are looking at from a more efficient structure is the feeder fund structure, is the FOF structure. So where you're not taxed on the churn, the dividend withholding is 15% instead of 25%, say in a UCIT kind of a structure. So looking at things where efficiencies can be built instead of just starting up and launching retail funds out of GIFT, maybe not the best idea. I think you need to probably go the feeder fund route from GIFT to, say, a UCIT structure to get the best and to improve performance. So I think research and just thinking about the clean, efficient structure is something that we're looking at.
The fund that will come up is also a feeder fund out of.
Yes, we are going to launch all feeder funds.
Okay. And there'll be one, or there are going to be multiple?
We are going to have multiple.
How many?
So right now 3. So we got a PMS running right now. But from a retail fund structure, from retail fund point of view, we're going to launch 3 funds over the next 1 year. I think 2 will be in the passive variety, and 1 will be an actively managed.
And what are the themes?
It's probably going to be a flex. The passive funds will feed into a passive fund like S&P 500 and NASDAQ. The active fund will be like a flexi cap kind of go anywhere kind of fund, where wherever we find opportunities, we'll invest there. Yeah.
Okay, there'll be broader index.
Yeah.
Not like particular themes.
Yeah,
or
but we'll stick to probably globalized businesses and developed markets. We won't get too exotic and going to say Thailand and China and stuff like that, where we don't really have the confidence in the country. So whenever we have confidence in the country and the rule of law is strong, we will invest our investors' money in those countries.
Fair enough. Vaibhav, what is your product strategy out of Gift City?
So I completely echo to what Neil had mentioned. So what happens in a gift city structure, the moment you buy and sell stocks, within a 2-year period, your tax incident moves to the marginal tax rate. So the most efficient structure is to create a feeder fund structure where underlying your funds are based in different geographies and your gift vehicle can feed into that. And those underlying funds can keep doing the churn without any tax incident. Thankfully, the advantage that we get is being a global AMC, we have about $300 billion across various of our offices. And we try and use some of those products and structures to feed into it. So it becomes a very tax efficient way for investors to access global investing without any tax incident because the underlying funds, especially in Singapore, Dubai, etc., don't pay tax while you churn the portfolio. So that's an advantage that we can create, and the India structure can be a clean way to invest globally.
Okay, and any themes that you are...
No, I mentioned to you a few themes that remain very bullish.
So those are the themes you will launch?
Yeah, so our product, which we had launched, a global allocation fund through the Gift City route, gives access to artificial intelligence, semiconductor.
That's a diversified fund.
Yeah, it's a diversified fund, gives you US, China, developed markets, and 3 or 4 themes that we remain very bullish. So it gives you a blended portfolio.
And any other funds you...
So we'll be launching a retail outbound fund, which will give access to investors to investing into global markets in a very simple manner. Like I said, one of our star products was NYSE FANG. Simple product, everyone consumes every day, so you understand it. Can we create a simple product which retail investors can understand, which they can invest in? So that's the idea that we will want to launch through our outbound fund.
And what will be the ticket size?
Ticket size will be about $5,000 to $10,000 within the TCS limits.
Okay.
So but I just want to add one thing which I think the Moneycontrol and everyone should educate is that the regulator allows accredited investors. And that's something that all of us have not utilized to the large extent. And through Gift City, you can launch products for accredited investors. So in our existing products, we even take 10,000 ticket size for accredited investors. So you don't need to wait for retail funds. You can have a lot of accredited investors coming through Gift City AIF structures as well.
Understood. Abhishek, will you also be launching out of Gift City now? Is that looking like a very alluring opportunity?
It is. To be very honest with you, internally, if I was to tell you, I think from my side or from the product committee side, the project is already done, submitted. We are awaiting our global approvals. As you will understand, one of the flip sides of being in a 100% global company, I think Vaibhav can, understand that, is that you have to depend on the stakeholders for final approval. So we were just awaiting that. But I think the opportunity is immense. And if we have a few minutes, let me add to whatever we have discussed till now. The opportunity is just not in terms of themes, but also in terms of asset classes. So if you were to think about real estate, REITs, the nature of businesses in REITs, real estate operating companies in the developed world is very, very different. Think about a 6 to 8% dollar yield product. Not only is it extremely differentiated, but it diversifies your portfolios in the true sense. Think about mezzanine products. You can possibly say that it is taking the risk to a different level, but these markets are extremely mature. Can those be brought in as private products through the Gift City? Answer is yes. So Gift City is extremely, enterprising from our perspective.
Right. Especially a lot of those products which are not present in India, themes, even debt products that are not available. Thank you so much, gentlemen. It was a very insightful discussion. Definitely, I learned a lot. Thanks very much and all the very best.
Right, thank you everyone for that fascinating look at how India's expertise is now attracting global investors. And thank you, Emil, for steering that conversation so insightfully. Now, let's shift gears, and because it's the celebration time, it's time to recognize the pioneers, the change makers, and the visionaries who are not just performing, but transforming the way India has investing. To do the honors, please join me in welcoming Akhil Chaturvedi, Executive Director and Chief Business Officer at Motilal Oswal, with a huge round of applause. All right, so our first recognition this evening is for the growth leader, South Zone, for highest net sales. And the award goes to Zerodha. I'd like to invite Nilesh Verma to join us on the stage and receive this well-deserved recognition. Zerodha, which is known for its empowering millions of first-time investors, has redefined how India participates in mutual funds through simplicity and innovation. Congratulations to the entire team for this incredible achievement. Next up is for the investor base excellence for highest investor base, and the honor goes to Geojit Financial Services. I'd like to request Dr. Ranjit RG to join us on the stage and accept this recognition. For over 3 decades, Geojit has been shaping investor journeys across India, building a strong presence both physically and digitally. This entire team and for the milestone journey, and thank you, Mr. Chaturvedi, for doing the honors and celebrating our industry leaders as well. But yes, let's keep the conversation flowing as we shift gears to our next big conversation of the evening. That is your finding alpha, because markets have been evolving. The search for true alpha never really stops, with consumption in infrastructure showing strong promise and defense stocks hovering near peak valuations. The big question on every investor's mind is, where are the next winners which have been hiding? And how do we separate the lasting rises from the short-term spikes? And what will define the alpha in the next leg of this market cycle? So decode all of this and more. Joining me for this insightful discussion are Mr. Deepak Shenoy, CEO of Capital Mind AMC. Mr. Anish Tawakle, Co-CIO Equity at ICICI Prudential AMC. And Mr. Harsha Upadhyay, CIO of Kotak Mahindra AMC. All right, the finding alpha, of course, in this market, this is the current market structure where we have seen a huge round of news, from tariffs to GST news, and definitely this year for the markets has been the year for consolidation. So given this market structure, where can we find alpha? What is the construct of the market that looks like? And how would you suggest investors to approach this? Anish, I'll start this conversation with you.
Okay, so I think, look, if we step back a little bit, right, like you said this year was a year of consolidation. That was happened for 2 reasons. One, I think the economy did lose a little bit of momentum. There's no fundamental problem with the economy, but it did lose a little bit of momentum, which we think it will recover. And the second was that I think expectations were too high, because you'd seen a period of very high earnings growth. That was because the economy was coming out of a slump, and then when businesses come out of a slump with spare capacity utilization improving, you get earnings growth which is faster than revenue growth, right? Because you get operating leverage with improving capacity utilization. But at some point that peaks out, right? So that was to be expected. The 2 parts to the consolidation was, one was a slowdown in revenue growth, and second was the sort of easing off of the margins. The second we should have expected, and to be honest, we think we did. Now, we expect things to recover. I think the clearest distinction I would make, right, would be I would stick to large caps at this point. I would be very cautious in the small and mid-cap space. I think there's been a lot of froth built up, a lot of companies with very sort of flimsy business models being valued as if they're great gems. So I think the biggest thing investors can do is to be cautious in the small and mid-cap space and like move allocations towards the large cap. Other than that, I would say if I were to take a sector view, I think in a recovering economy, cyclical sectors do well. That could be sectors like industrial capital goods, cement, automobiles, and some parts of financials. Those would be my preferences.
Anish, coming to your point, and of course I'll toss this question to Deepak first, that earnings growth, they have been in single digits, and now much of the onus is lying on the second half of this fiscal year for the market to actually perform and pick up from there on. So how would you see the second half from here, given the GST cuts have been announced, and what would your analysis of it?
So I think it's been a rough year overall, overall markets and so on. We've had lots of things around tariffs, and I think a lot of this is noise. Noise that typically gets amplified when markets have anyway got a bearish turn to it. So there is always an excuse to not invest, and there is going to be an excuse to invest at some point. But I think money is made, or alpha in that sense, is made when things are not clear. It is when you make your bets over the longer term and then kind of change things around. But what I would feel is that in general, while earnings have not shown any miraculous insights in the last 6 months, some of the early data indicators seem to show that at least in some parts of the market, there is a turn in the core economic fundamentals. It may be in consumer durables for the most part right now. I think visibility is in cars and in some of the durable elements. The defense players have shown it already, and the recent numbers haven't been quite as exciting, but we need those numbers to kind of work their magic towards the end of the year, which is when I suppose a lot more of those defense spending numbers will come into place as well. So a lot of these sectors are early stage in their recovery process. Some of the others, like manufacturing in general, have been showing for the last 4 or 5 quarters some move upwards, especially in high-end manufacturing, wherever there is investments happening in that space. We're starting to see the early results of those. I think that those are the areas where we're going to have long-term growth. Now, I don't say long-term as in 1 year and all that. I would say if you have a longer-term approach of 5 to 10 years, that's where things will probably move. I'm not very keen on India has been traditionally very heavy on cement, steel, some of the, base metal kind of sectors. But if you look at the US, that's moved away from there. It's moved quite considerably away into technology. And perhaps India will also evolve somewhere along those lines, where something higher than the so from the metals you go to the cars, from the cars you go to the electric vehicles and the the technology that powers them and so on. So perhaps we will also go upward. So the leaders of yesterday will probably not be the leaders of tomorrow. So you have to plan the next 10 years thinking of what will be the leaders of tomorrow rather than the leaders of today.
Asha, I'll get to you now. Flows has been a key factor. We've already seen this year FI outflows of about 1.5 lakh crore rupees. So how would you determine these trends to go ahead for a market to perform like India?
See, I think whichever forum we go, there is a lot of questions about FIs are selling, why are DIIs buying, or why should Indians be buying when they are selling? If we had followed what FIs have done over the last 3.5 or almost 4 years now, calendar 22, calendar 23, calendar 24, and this calendar year to date, they have hardly been investors in India, right? But still, markets have moved up in last 3 years, 10 months. So just because one segment of the investors are not looking at India for whatever reasons, right, wrong, that is not, I'm questioning. It doesn't mean that everybody has to follow them or everybody will view the markets in the same way. So I don't think the flows alone will determine how markets are going to do. I'll just give you a simple example of last year, right? Defense, for example. Everybody wanted to invest in defense. There were not too many products that were available. Diversified funds had maybe a couple of names in defense, in all those portfolios. And there were a couple of peers in our industry who came and launched defense funds, right? And in defense, there are only 18, 20 stocks even today. At that point of time, maybe there were even fewer stocks. And those mutual funds raised a lot of money. But did defense stocks immediately go up? No. The flows were there and everyone wanted to buy. There was euphoria. Why didn't it go up? Because for every transaction that takes place, there is a buy and a sell as well. The intensity of the buy or the intensity of the sell is going to determine whether the stock is going to go up or down. And this is very, very misunderstood concept that there is money and hence market will move. There is also somebody who is selling it. So I don't think just because we look at one side of the coin, we can decide that it's going to go up or go down. It doesn't happen that way. And finally, when valuations come to a reasonable level, in the opinion of everybody who is operating, or when the growth exceeds the expectation of most participants, that is when you will see that outperformance coming in again. So I don't think we should be looking at just the flow as one determinant in terms of how the stocks are going to do, and especially not definitely, one segment of the flows, if at all you are looking at flows also.
I'll come to you on your defense perspective that you said that earlier, we did see last year plenty of funds did stop SIPs for the defense theme in perspective as well. But this year, how do you see the growth story to pan out for the next couple of years for the defense as a sector? Because we did see geopolitical tensions that came in for India, and that's when all the defense stocks took a jump.
See, you will see more and more companies getting listed in this space. Right now, the opportunity set may be quite small, but I think if you look at next 3-5 years, most likely there will be many more defense-related companies which will come for listing. So that will enlarge the overall investment space. Second, I don't think we will ever be in a situation where everybody is cutting down on defense capex. I don't think India can, at least in the next several years, can do that. But even from a world perspective, it is very, very difficult to imagine that there will be no conflicts, no wars, and everyone would be cutting down their defense budgets. And right now what's happening? The US, which was kind of giving protection to NATO partners, is asking for a price. So all of those individual economies will have to invest in defense if they have to remain relevant, right? So that's one part. Second, as I said, the conflicts will continue to be there, or at least the fear of conflict is going to be there. Even if there is a fear of conflict, you will have to spend, right? So spending will continue. So there is a long-term growth that you will see in spending. There is also additional factor for India. We have been largely reliant on imports for our defense needs, but that is changing, and especially after the war with Pakistan, the recent one, we know that you have to be self-reliant in most aspects, if not all. Otherwise, there is a risk. So to that extent, more and more indigenization will happen, and there can also be export opportunities once in a while. So I think from a long-term growth perspective, there is definitely a lot of growth ahead of us. We'll have to pick and choose at what valuations you will be comfortable buying some of those companies. Sometimes they may look expensive when you look at next 6 months, next 1 year, but they may be reasonable buys if you're looking at next 5 years. So some of those things you will have to do. The initial euphoria is clearly there. So to that extent, easy money is not going to be there. You have to be very selective. You have to decide your investment horizon, and you have to manage risk. I don't think the entire sector is going to perform uniformly. You will have to definitely pick and choose.
Anish, I'll come to you on this, on the defense and the entire indigenization theme that we are talking about. If you look at defense theme as a subsegment, we've seen drone stocks also picked a lot of momentum when the geopolitical tensions had emerged. And of course, we've seen how aerial combat is one of the major weapons that India has been using, and of course, everywhere across the world as well. But for India, we still import a lot of material from Israel. So how do you see this particular segment for the upcoming years?
To be honest, I'm not an expert on this field. I also feel that, defense is such a small part of the market that too much time is, as Harsh said, there's euphoria in that space. There's too much time spent on, trying to discuss this theme almost to death. Look, I mean, at the end of the day, yes, there is indigenization, and some companies will do well, right? The point is not, I always say this about investing. Demand growth is never enough to make returns. Ultimately, you need some moat, some entry barrier, some special skill that allows you to make supernormal returns. Just because there's demand growth and there are hundreds of players, not all 100 will do well. The one that develops some competitive advantage is the only one that will do well. So, to be honest, I struggle to identify which ones those are. So I have a relatively limited exposure to that field.
Deepak, your viewpoints on the same. Of course, not just defense, but manufacturing as an entire theme has gained quite a traction given the government's thrust on the capex. So what are your views on the entire theme of manufacturing itself?
So yeah, look, you have to excuse us as fund managers because we will always be bullish at some level. Right, so I think very positively bullish in the long term, but like Harsha and Anish have said, there are challenges in valuation. So you can't buy anything at any price because you think it will go up. The company may do well, you might not do very well as an investor, right? So you want to be sure that what you're picking has the kind of growth that gives it, in a certain sense, a moat, and in a certain sense, a growth path that gives it the ability to get a market share that is reasonable enough for you to make money off of, even if the valuations were to drop from where they are today. That's the problem of today. You're not getting those, shooting ducks in a barrel kind of investments. So it's just that much more difficult. I might love the theme. I might still choose not to buy a stock because, it's just too expensive. The defense and manufacturing theme are kind of hand in hand because in the end, if you're making a drone, are you betting on the guy who manufactures and sells a drone, or is it the components? If you're buying an armored truck, is it the car company that makes the money, or is it the defense company that somehow packages the armored truck? So these are questions you have to answer over time in terms of understanding which companies have the tech and which companies perhaps don't really have the tech, and they're just taking something from some other place, repackaging it and selling it onwards. May not necessarily be as good a moat as someone that owns the tech. This is where I feel that there's a lot more work happening now. Some of it is in the unlisted space, and perhaps they will come into the listed space, but a lot in the listed space is also using their coffers, which they have kind of built over the last 10 years. The debt to equity ratios in a lot of public companies have come down, has come down substantially. So companies have much stronger balance sheets. They have the ability to invest. They're perhaps starting to because although the government's been pushing it, the industry has not been as keen to just say, well, we can't just start doing this as a whole. But now you see companies talking about 70,000 crore investments, 20,000 crore kind of investments that are happening. This space is very exciting because I think India, which used to import like 80% of what it used to use for defense, and a substantial portion of what we use on our own. Strangely, we're one of the largest textile exporters in the world. We don't make a single sewing machine. 99% of our sewing machines are imported from China, 1% from Italy. We make a lot of industrial, equipment. A lot of that industrial equipment, the machines that are used to manufacture the tools for them, don't come from India. They come from China or some other sources. So we have not really gone into the supply chain of these elements. And there are dependencies that we should perhaps, evolve into removing as well. I think there is some focus on it, early focus. Rare earths, for instance, India is the second or third largest, has a lot of rare earths. We just don't process them. And it's not easy to process them. But if we don't start now, when else will we start? At some point, some companies, either downstream or upstream, will make money on this. But it's too early to say right now. Just saying that this is a theme, I don't think tomorrow we should go out and buy some rare earth company. There will be companies that will call themselves rare earth, because India likes naming companies according to whatever they think is a new fad. But I think we should be more careful about that. So I'm positive on the theme of manufacturing and defense, with the caveat that you should be careful, you know what you buy, and that it has the growth path and the valuation space to grow ahead.
Can I add a nuance to, about 7 years back, when we launched our manufacturing fund, I was the fund manager. And when I went around to market that fund, it was almost impossible to get any meetings. It was like, why are you wasting your time on this fund, right? And the environment has shifted dramatically. But I think there is one important nuance that I do want to add, and that's my view. I think the narrative, like, I'm more confident around manufacturing for domestic demand than I am for manufacturing for exports. And the domestic demand manufacturing, in my view, will be a follow-on from whether we build cities and whether we build homes and whether we build urbanization. So let me explain what I'm saying, right? See, any country that wants to attract investment, if you want to attract capital, you by definition are also saying you'll run a current account deficit, right? So saying, look, we are exporting, we have a current account deficit, it is the flip side of attracting investment. We can't change that unless we say we don't want to attract investment. Now, when you're going to run a current account deficit, you'll be exporting some stuff and you'll be importing some stuff. Because we are very, very good at exporting, and our exports will be less than our imports. We will import more than our exports. That's what a current account deficit means. Now, we are very, very, very good at services. And our people also would rather be working in an IT company in an air-conditioned office than on a factory. And I always say that people who talk about manufacturing have actually never worked in a factory to realize how hard it is. So the point is that we will, given that we are very good at exports, at services, we will always be a net exporter of services. So if you have to attract investment, run a current account deficit, be a net exporter of services, mathematically, it is axiomatic, it's almost a given that you will be a net importer of manufactured goods. So our trade deficit in manufacturing is not a problem, it's a feature of our economy, which is very strong at services. Now, that's why I'm more confident of domestic demand. And then if you say, okay, what drives demand for manufactured goods? Ultimately, it's the size of your house, right? All durable goods demand for manufactured goods depends on the size of your house and your office. If 5 people are living in a small house, there's only so many shoes they can buy, there's only so many air conditioners. So ultimately, it has to be like this whole manufacturing story will be driven if we get housing and urbanization right. Otherwise, you see, like we already make pharmaceuticals because that doesn't depend on the size of your house, that's manufactured. We make two-wheelers, we make cars because that you park them outside the house, it doesn't, the fact that you have a small house doesn't. But everything else which we don't manufacture enough of is because we don't have housing to accommodate that.
Anish, I'll get to you. Before we discuss much about the sectors, you've been the man behind steering the blue chip fund. So be it your 3-year or even 5-year returns, it has beaten the benchmark. So tell us, if the FII participation is something that is going to take some time, so what are the trends that are going to emerge for the next couple of years from here?
Oh, so look, as I said, I manage both the large cap and the small cap, so I have no inherent bias per se, but I do think large caps offer better opportunity. And I'd say, look, when 7 years back when I started manufacturing managing large cap fund, it was mostly useless activity because the index funds or the ETFs will replace that. The good thing is that's not happened, not just our fund, but a lot of other large cap funds are also beating the benchmarks. That's because, I think in large caps particularly, see, you don't get multi-baggers, that many multi-baggers, right? So you don't really have to chase the best stock. What you have to avoid is the stuff that really bombs, right? If you, as long as you avoid the minefields, avoid the stuff that ends up in the bottom 1/3, it doesn't really matter whether you get the 5th stock or the 10th best stock. The difference is not that much. You have to avoid the big disasters. And that approach of sort of, I spend a lot of my time on saying, okay, which ones will really bomb rather than which ones will do spectacularly well. Oh, the returns come on their own. You just avoid the minefields.
Asha, how would you react to this argument that, large caps wouldn't be the next multi-baggers, of course. So is the stability and the margin of safety is something that we'll be watching out of from the large cap space?
Yes, definitely. I think if you look at overall valuation picture, large caps at this point of time not only offer better visibility on earnings, but they are also available at more or less around historical valuations, right? It's not very, very attractive valuation, but they are not expensive to the extent that mid and small caps are expensive. So to that extent, in a scenario where we are just expecting recovery to happen in terms of earnings growth, I think this is a basket that you can't ignore. And also, if you look at the previous few years of performance, this category has underperformed mid and small caps. So to that extent, yes, the relative safety is slightly more in case of large caps.
Deepak, what's your view on this? This entire equation of large cap, mid cap, and small caps. We have seen earnings decline for the past 2 quarters when it comes to small caps, but mid caps, they have been quite resilient from the past 2 quarters, and that is where every investor participation has been. So where does the large caps fit in this entire picture?
That's a good question. Actually, I think the definition itself is the problem. Because about 7 or 8 years ago, when SEBI came up with the classification of what is a mid cap and a small cap and a large cap, the largest small cap was about 7,000 crores, if I remember, or a little bit less than that. Today, the largest small cap is 36,000 crores. It means in 7 years, if you've gone up 5x, you're still a small cap. Not a bad return to get, but it's just that you're still going to be called a small cap. Whereas some others have gone up 15 and 20x, and now they've become mid caps and large caps. So if you look at some of the large caps history, you say, oh, this large cap has done 50x in the last 10 years or something like that, but it was a small cap to begin with. So these cap boundaries are arbitrary and time-based in that time frame. So large caps don't have any room to go beyond. You can't become a larger, it's still going to be a large cap, right? So at some level, you're fighting at the top end of this cycle. And I think even now, there's a lot of room at the top to grow. Because if you look at the US in the last maybe 4 or 5 years, it isn't that the large caps have underperformed. The Mag 7 are pretty much what are driving the US markets ahead, right? So it's the largest companies just becoming larger and larger. There have been phases like that in India as well, where the large companies got larger. It is maybe in the last 4 or 5 years when the large companies didn't get necessarily larger, but other companies kind of caught up to it. We went into that phase. We could easily move into another phase where some of the larger companies are able to invest, have the balance sheets to take their growth forward into an era which perhaps needs an investment to succeed and get into that place. As Harsha said, they're available at better valuations. So if you gave me a random choice, I would rather choose from a set of large caps than from mid or small caps. But because we're also investors who will look at, down deep and not pick randomly, I think there'll be great investments to pick from both the large, mid and small cap space. And this will forever be the case. You could ask me this 10 years later and I'll still tell you the same thing, except the only thing will be perhaps my fund size that will perhaps determine whether I can pick up a really tiny cap or not. Whereas I'll always be able to pick up a large cap whenever I want it. So that would probably be the differentiator between being the ability to pick. Sometimes I like this company, but it's too small for me. Bade ho jao, become bigger, only then I'll buy you, is the problem that a large fund manager has. But a small fund manager has a little more flexibility in that aspect. So I think that's by and large the answer. Even today, I would say that today specifically, you would have a little bit of an edge on the large cap zone in terms of valuation comfort. And some of the small and mid caps have a tremendously large percentage growth to be had because they have a much larger field to grow. So, some of these small companies may actually grow 3-4x simply because they have been way too small for too long. But the large caps don't afford that opportunity. So I think it's better to pick because you will not be 100% sure of growth in any place. You want to pick between all of the three in order to make your portfolio a little more stable in that sense.
Okay. All right, I'll come back to sectors once again. Harsha, let's start with you. Consumption, that is the next big theme that the street is watching out for. We have had the RBI rate cuts, GST cuts as well. So do you think that this is the next big theme that investors should be, focusing on right now?
Yes, I think if you look at next 3-5 years, the income levels in our economy will definitely go up. And some of these policy measures that have been taken by the central bank from the government will also help enable better consumption. So yes, I think if you look at it as a theme, it should do well, but it will have its own ups and downs. Just because we have seen very good festive season due to GST cuts, one should not extrapolate that everything is going to grow at the same pace forever. So there will be ups and downs. And also the initial rally has already taken place in many of these stocks, right? In the last 2 months, many of these stocks are up 15, 20, 25%, which is essentially 1 year of earnings. So to that extent, some of it is already discounted. So don't go by what the last few months of performance have been, and don't expect same thing to get repeated every now and then. But if you are a 3-5 year investor, I think it's a very good theme to be in, and expect a long-term compounding rather than a similar kind of short-term performance to continue.
Anish, I'll come to you. Within the consumption theme, the staples you have been quite underweight on. So would you maintain this stance going forward until there's a clear visibility on margins?
No, so staples, I have been saying that the problem is not weak demand. I think the demand for staples is fine. It's that the companies are over-earning and under-investing. So their margins are too high. And that call has worked. And I would wait for them to start investing more, for the margins to come down. That should mean earnings cuts. And then they're strong companies. I'm not saying the companies are not strong. They're very strong companies. They have excellent brands. They have excellent people. But no strategy, if it doesn't invest enough, can lead to growth. Ultimately, you need to invest in the business to grow.
Okay. Deepak, I'll come to you. Within the consumption basket, the cement growth story is something that everyone has been watching out for. Of course, the price growth story, and of course, the industry has gone under plenty of consolidation as well. How do you see this?
To be fair, my views are a little weird on this in the sense I don't think it's a great long-term story. Cement is a cartel in India for the large extent, and they're able to determine prices by talking within each other. And there are times when they will compete, there are times when they will collaborate, and money is made largely because of this kind of construct. But I don't feel that this has great long-term potential, because my cement versus your cement, there's not that much of a differentiation. Eventually, it is this cartelization that helps, and demand that kind of drives this. There is no meaningful excellence in cement, whereas I could be meaningfully excellent when manufacturing a car and so on. So on the consumption front, I think there is some element of premiumization that I would pay for, a premium. But I don't want to pay 30 times earnings for a cement company as much as I want to pay. I might pay 50 times earnings for a company in the consumer electronics space that is growing quite a bit, but not so much for the cement players. And if I'm getting both of them at the same valuation, I would rather choose the players that have perhaps a larger and more structural growth path. So I like consumer durables. Within that, we've the automotive space is exciting. The consumer durables, white goods, some of the companies there are interesting. There are companies downstream in semiconductors, early stage. So there is some focus on that. But these are not really the consumption names that you might hear about, because mostly those are consumer staples elements. The problem with consumer staples is their best growth seems to be 20%, and by and large, the lowest growth seems to be like 10%. So my problem is, if I'm paying 50 to 70 times earnings for this, I feel that it's difficult to get a longer term return on this. However, I mean, there will be times in which even these companies will be exciting. So there are times when you go with more of a cyclical short-term approach and more with a structural long-term approach, where I think you'll have different baskets. Some elements from the staple space even today, but I have a larger set of elements that we would like in the, or we think will do well in the durable space more than the staple space.
Okay, I've been told the time is up, but I'll just take the last round of question. Harsh, I'll start with you. We've discussed consumption, manufacturing, but what are the next 3 pockets that you're seeing to be the next big growth stories?
See, there are a lot of areas which are still emerging, and India is an emerging market. So I don't think the opportunities will ever cease to exist. It's just that we have to be cognizant of the valuations at which we are buying some of these companies. For example, electronics manufacturing, while it has done very well, but the runway for growth is very large. Semiconductors, we have hardly anything in the entire ecosystem. That's just getting built. So there are many, many such examples where we don't even have a minute market share in the overall globe. And as India tries to become more self-reliant, I think they spoke about rare earth, etc. I mean, you can name many such industries where we hardly have any market share, and we will try to garner at least some reasonable share over the next 5-10 years, right? So there will be many companies which will be in the listed space over a period of time from these segments. But again, I don't think just because one sector is going to grow at a higher pace than other sector, you are going to make a lot of money. You also need to see at what valuations you are actually investing into some of those names. But I think being an emerging market, India will never have paucity of opportunities in terms of new sectors and new businesses.
Okay. Anish, the three pockets that you would pointed out, three exactly we need it.
No, so I mean, at this, I take a cyclical view. I don't take 10-year structural views when I'm doing sector picking, because I don't think that the entire sector does well over a 10-year period. But if I take a sector, if I have to choose sectors, I say, where is the economy? Will it regain momentum? For me, yes, then the answers would be industrial and capital goods, cement and auto.
Deepak, what's your view in this?
The sectors?
Yeah, there are three pockets.
I think, it's, things keep changing, so we will change. I think at this point there's a lot of interest in healthcare, specifically in hospitals. Even though they are expensive, there are some pockets over there that are interesting. Auto, that seems still to have a lot more potential. We haven't reached the car, even the two-wheeler sales numbers that we got to in 2018 per month, which is a long period that, we have not had meaningful growth in that sector in. And I would say in general manufacturing, and like Anish said, the Make for India platform rather than the Make in India for the world kind of platform, that is where I think the most interest is. I'd say, these are long-term themes that have run in our portfolios for a while, and I think they will last a while unless some political or geopolitical issues crop up that change things.
Okay, all right. Thank you, gentlemen, for this conversation as well.
Thank you.
And thank you so much for this.
Thank you so much.
Thank you to all our panelists for decoding what drives the performance and conviction in today's fast-changing market as well. But yes, up next, let's turn our attention to a remarkable trend, the rise of the investor nation. As of last month, we did see India reaching nearly 12 crore unique registered investors on the NSE. But this isn't just about numbers. It's a reflection of a powerful cultural shift, a nation that isn't just earning, but actively investing. Not just saving, but building wealth with intent. So we are witnessing the emergence of a new financial identity, India as an investor nation. So to help us decode what this surge means for the market depth, wealth democratization, and the future of financial inclusion, please welcome back N. Mahalakshmi to moderate this discussion. Joining her is a visionary leader shaping India's asset management landscape. Please put your hands together for Navneet Manod, MD and CEO, HDFC AMC, with a big round of applause.
Thank you so much, Lavisha, and thanks so much, Navneet. It's always such a pleasure talking to you. And today's discussion is, especially interesting. The rise of investor nation, something that you and me have definitely aspired for many, many years, for 20 years. So what has happened? The mutual fund industry has definitely transformed over the last 5 years. It's like a pre-COVID versus post-COVID era. How do you describe this transformation? How much of this would you say is maturity, and how much of this would you call momentum?
Thank you, Mahalakshmi, and for HDFC AMC. It's such a pleasure to be associated with Moneycontrol in curating this thought leadership summit. I mean, we had one in Mumbai, and this is in Bangalore, and always a pleasure to be in Bangalore. I mean, people say that this is India's Silicon Valley. I think in my lifetime, hopefully I will see where many countries will have a city like that and they will say this is our country's Bangalore in terms of innovation and the whole energy that this place has.
Cheers to that. Let's clap for Bangalore.
People crib about many things, but I have a strong belief that, and I've been saying for even 10 years back, people used to say about the traffic, and I used to say that wherever there are like talented, energetic, enthusiastic, optimist people are there, I mean, there would be a network effect. More people will gather there, regardless of some of the challenges, because the opportunity is so big and the environment is so positive. On our industry, as Jeff Bezos said that we had a great quarter, but I mean, we would have worked for it for 10 years. So our industry journey over the last couple of years, where we have seen significant growth in terms of number of investors, number of folios, number of zip codes that we would have covered, the amount of AUM, the SIP book, SIP accounts, so on and so forth, would have been like years of hard work. And I mentioned it many times that I think the 4 factors that have driven this growth in the last couple of years, and we'll keep it short, I mentioned it several times before. I think one is a track record. Historically, the 2 questions that, and several fund managers are sitting here, several of my colleagues who have been like veterans in the industry sitting here on the sales side, typically 2 questions that you used to get asked during the like bull market, abhi profit book kar le ya ruke? And start of like, abhi laga dein ya ruke? So it was always like, even in a mutual fund, you are investing for a year or 2 and just playing the market. And for years, that was the case. Now, I think investors can see a 30-year track record of several of like our funds and some of the other funds. And I think they get confidence that volatility is an inherent part of it if you want to make good returns over a period of time. The second, technology has played a big role, and we have a session on that. I won't talk more about that at this stage. Like our number of investors have doubled at HDFC AMC in last 2 years, and technology has played a big role in that. The third is the transparency. We take a lot of pride that our industry, along with market regulator, has worked very hard to make this product more transparent and most cost efficient for every investor. And last but not the least, I think the biggest role has been played by just to create the acronym track record, transparency, technology, and training, but that's the investor education. What India has done is something very unique. Very few places in the world have done something like what we have done. The whole campaign of mutual fund Sahi Hai, backed by deep efforts on investor education. And I think combination of these reasons has led to the substantial growth we have seen. But these are very early days. We can pat on our back by saying that, number of investors have grown, AUM has grown so much. I mean, at HDFC AMC, we manage more equity AUM than what the total industry had till few years back. But we have a long way to go, long way to go. This is just beginning.
True that. So my question was, how much of this is maturity, momentum? You definitely, from your answer, I gather, much of it is maturity.
I think resilience of domestic investors, you have to give it to them. There's a lot of maturity, a lot of resilience. Our distributors and the advisors have played a very big role. People like you in media have played a very big role, and of course, efforts of the industry in terms of keep communicating the message that you are investing for certain goals, you are investing for the long term, keep focusing on the asset allocation, discipline is more important, and I think that message is resonating. You can see last couple of years, people have been telling me like, people have only seen bull market, they haven't seen a severe correction. But think about it, the SIP book was 4,000 crores in 2017, then it became 8,000, and then 16,000, and 29,000. In this period, you have seen significant rise and fall in mid and small caps in like that 18-19 period. You saw the COVID where you had 30% drawdown in a single month in the month of March. You saw a lot of volatility in 2022. You have seen like last 1 year, not only in like small and mid caps, but overall market. But the SIP numbers, both in terms of number of accounts and the AUM, is increasing month after month. I think that shows the resilience of the investors, that shows the maturity of Indian investors.
Sure, I agree to the point that, continuously, I mean, what we feared that every market correction will be followed by redemptions is no longer true. But the data that we see on investor, portfolio churn, that still seems like a very immature investor behavior. The stay of investors in a fund is still only 2 years. And there is not one single fund manager or fund house that is not shouting on top of the rooftop that you have to take at least a 5-year view. Nowadays, people also say a 7-year view. Despite that, the data shows us that investors are not patient for more than 2 years. So what do we gather from this whole thing? Is it that they are driven by performance? Is it because they're constantly looking at which is the next, for the next 1 year, where should I put money based on last 1 year? What's your thought?
No, it's a journey. From our interaction across the country with investors and distributors, we can clearly see a more maturity. We can clearly see investors investing for long. Again, it's a journey, right? I mean, after 100 years in the United States, people would be chasing momentum on many things. I mean, you can see the ETF flows globally, not only in India. I mean, they only pick up, the ETFs in, let's say, a gold and silver fund, they only pick up when the asset class has done extremely well. There is a recency bias, which is very inherent among the investors. There is a bandwagon effect. Having said that, I see that maybe thanks to the efforts of everything that I mentioned before, more maturity among the investors and even the advisors and distributors, everybody I meet, everybody has been advocating for remaining invested for longer term rather than keep chasing the short term performance.
No, good you touched upon this gold, because it is indeed true that it's only in the last few months that, when gold started doing so well, not that it has not done well in the last 3-4 years, but that you saw so much money coming through the ETF route. On the contrary, in India, so much so that Uday Kotak said that, Indian housewives are smarter than everyone else. But the fact is, gold did not perform for 20 years. And, 4 or 5 years of performance has actually, it's changed the complexion of 25-year returns in gold now. And the thing about gold, at least taking India's example, is that people don't sell gold because they're so emotionally connected to gold. You just don't want to touch your gold. Is there a way for the mutual fund industry to really connect with investors to gain their emotional loyalty so that, they stop chasing performance? Or is it too idealistic? Or is it even a bad idea? Because we're always told that you should never get wedded to your stocks. You should not be emotional with financial decisions. What's your take?
It's very interesting. A lot of people talk about the wealth effect India would have because of the rise in gold and silver prices. And my view is that unlike other asset classes, gold and silver doesn't create the positive wealth effect in India. And it's very interesting. May sound very counterintuitive. Because when gold and silver prices are going up, regardless of the amount of gold and silver you have in your house or locker, you feel poorer. You know why? Because you think that I'm going to buy more.
Yeah.
And I have to buy more. And my next purchase is going to be higher.
Costlier.
You don't feel positive and go and spend that money. If you own stock and the prices have gone up, people spend that money somewhere else, even if they have not realized that gain. If you have an additional real estate other than your house, prices have gone up, people spend that money in some manner because there is a positive psychological positive implication, but in gold and silver it doesn't happen. Maybe as the holding goes up in the form of ETFs and gold fund over a period of time, this will have that wealth effect. The other thing we really need to think hard, how do we really get that gold and silver into the productive uses? It's a couple of $1 trillion of gold and silver which is unproductive for the country. And there should be a way of I'm just thinking aloud that if we allow that gold and silver to be sold and put that in equity, and let's say you say maybe an ALSS with 5-year lock-in and no tax, I think there was possibility that a lot of people monetize that and put that to a more productive use, which will be very good for the country.
You
and I hope it happens.
Swap their gold in today's environment to equities?
I think so. So equity is cheaper per ounce of gold, isn't it? And per ounce of silver, it's cheaper today than what it was 6-7 years back.
No, I take your point.
But I've said this just a couple of days back, that those who are saying that gold and silver can only go up, go back in history. There have been long periods of underperformance between early 80s to early 2000s, there was a 20-year bear market. Prices fell from $800 to $230 per ounce, and then it started rising. I think there have been like many of those periods, yeah.
So that is why I was asking that, is there a way, I mean, is there something for us to learn from this emotional connect that people have with gold? People don't have that connect with equities, or for that matter, mutual funds, because that is why...
It's changing. Don't underestimate what's happening.
What was it?
Today.
Numbers don't
I
show.
have a very strong view. I've quoted this many times. We have spoken, Mahalakshmi. This nation is transforming from a nation of savers to a nation of investors. A nation of savers is transforming into a nation of investors. People are a lot more optimistic. People are a lot more aspirational. People are more ambitious. People want to create wealth. And they are exploring many things today. There are people who are doing F&O. There are people who are on gaming apps. There are people who are trying IPOs. They are trading stock. They are investing in mutual funds. They are doing all kinds of things. But it just reflects that everybody is like looking to create wealth or looking to make more money. And I quote this often that in the long run, how much wealth you have doesn't depend on how much money you make. How much wealth you will have in the long run doesn't depend on how much you make. It depends on how much money your money makes. And I think more and more Indians are understanding that. In HDFC AMC, we had this interesting campaign a couple of years back called Barni Se Azadi, because every Indian housewife would have few hundred rupees or tens of rupees historically in that Barni. In the kitchen jar. And I think what we need to do is to kind of motivate them, inspire them towards putting that money to the productive use. This is a revolution which is underway. Don't underestimate it.
Okay, not underestimating, but any concrete ideas or any a different way this messaging about investing for the long term can be made? Is there anything that you at HDFC AMC or the industry is working on? For example, one thought I have is that, you know, in the end, everyone talks about performance, whether it is the investment advisor or the investor or even the fund managers or the AMC. You know, everybody asks this question, everybody is interested in this question, and that is why, in the end, the investor behavior is also governed by that. Do you think it's a good idea to move away from this kind of disclosure or return, you know, time periods for which we display returns and so on? Because in the name of transparency, we share a lot, no quarrel with that, but that is also sort of reflecting in investor behavior.
I mean, we disclose everything, right? Right from 1 year to like since inception. And I mentioned earlier that several of our funds have been in existence for 30 years. They have a performance track record of 30 years. And more people, and again, every time we talk about 30 years, we say mutual funds are subject to market risk. Please read the offer document carefully. Past performance is no indication or guarantee of future performance. Having said that, that gives them an understanding that in between there would have been many economic cycles, business cycles, profit cycles, market cycles, political cycles. But India is a compounding story. Other than United States, there are very few places in the world which are a compounding story like India. Over a 30-year period, your nominal GDP grew at, I think, 10, 11%. Corporate revenues and profits grew slightly higher than that, and market capitalization grew slightly higher than that. An economy which grows at a very decent rate for such a long period, a corporate sector which can convert that growth into their revenues and profits, a market which converts that growth into the returns for a minority shareholder, and a mutual fund industry which converts that growth for somebody who's investing only 500 rupees per month. That hasn't happened in many countries in the world. In India, it has happened. There's no reason to believe that next 30 years that won't happen. And I think more and more people look at that aspect. I think more confidence will get built in. We are not selling returns of 30 years. What we are selling is the concept that over a period of time, India is a compounding story, and it makes sense to remain invested in a highly disciplined manner. I think in the earlier panel, you talked about many things, manufacturing, I think whether services and all kinds of things. If you look at the larger forces in India today, the bigger forces are the digitalization of the economy. Within that, digitalization of finance. And both these helping, and with many other things happening, is the formalization of the economy. All of this together leading to financialization of savings And a very interesting thing happening is financialization of assets. So you have, whether it's real estate in form of REITs, whether it's infrastructure in form of InvITs, whether it's gold and silver, which is in the ETF form, so on and so forth. And all of these are like reinforcing each other, and they're like very, very powerful forces.
Oh, absolutely. In fact, if you went back, even 15 years or 20 years, they were just equity and debt and hybrid. And today you have funds of all shapes and sizes, but not within these asset classes. You can take exposure in REITs, except that there are only 5 REITs available, and I hope that market grows. But for all practical purposes, every asset class is now represented or you can participate through the mutual fund route. So Navneet, if you just look into the future, let's not go too far, let's say 5 years, what do you see will be the complexion of the mutual fund industry? And is mutual fund enough for a family? I mean, for you to put all your money, is that one vehicle good enough to keep your entire pool completely diversified?
Yeah, so the industry has moved from like a product-led to a more solution-led. And you have like all the solutions, right? A family may have need to like park some cash surplus for a few days or weeks. You need income, so you have products for that. You need like long-term wealth creation, you have products for that. And over a period of time, you'll see more solutions emerging for all kinds of investors.
And how do you see these alternate, for example, now international investing through gift cities coming up? We spoke about the SIF category that has come up. SEBI has, the taxation around REITs has been revisited. How do you see these pockets really growing? And how do you see the overall composition of the industry itself changing over the next 5 years?
So sure, I mean, we are the 4th largest economy in the world, 4th or 5th largest market in the world. This is an entrepreneur-driven economy rather than a state-led growth like some of the other places. All of these markets will grow tremendously. Several times I mentioned that there are striking parallels between 1980s in US and now in India as far as asset management and wealth management industry is concerned. You can go and see the playbook. You can go and see the growth of various segments. So everything will grow here. Active funds will grow, passive funds will grow, private equity will grow, venture capital will grow, real assets will grow. I mean, you will see like growth in almost all of these segments the way you have seen in US from 1980s onwards.
Okay, I take that everything will grow, but today, you look at...
also, and international also. I tell you interesting about international. So before early 70s, the US institutions were not investing outside US. And then all the classical theories that don't put all your eggs in one basket, you need to have international diversification. So over a period of time, they started diversifying quite a bit. I mean, quite a bit meaning still because US has always been a large part of the global market, but still within that, they started diversifying. But for 30 or 40 years now, anybody who diversified internationally has underperformed because the US markets have ended up outperforming. Having said that, there would be need. A lot of Indian investors would like to take exposure to other markets than India, and I'm sure there would be products, and Gift City is a good vehicle, yeah.
So how do you will these new categories, could they become 50% of the AUM in the next 5 years? Do you see something
What
dramatic?
New categories like your...
I'm saying, for example, gold ETFs, can they be a really big... because right now momentum is with gold and silver. Of course, they corrected also.
It will be a dream for the industry because not that of our overall AUM. Look at the size of the gold in India.
Yeah.
A large part of that becomes financialized and gets fractionalized and whatever, tokenized and get traded and come to the more mainstream system where it can be leveraged for the overall growth of the economy, it will be good. If you look at the household balance sheet in India, 50% is real estate, 15% is gold, 15% is bank deposits, equities is less than 6%. This number was 2.5% 10 years back. So 2.5 has only gone to now a little over 5%. That has a much longer way to go. And on a lighter note, whenever people ask me about the future of alternatives, I say that the whole country has invested in alternatives, which is real asset and gold. The mainstream traditional asset class equity, they are yet to invest.
No, I take your point on growth, but the reason I'm asking you this question is because today, if you just look at the macro picture, market cap to GDP for India is 130%. I mean, it's the highest in the world. So it should tell you something about where we are in the equity markets. And are we, by sort of saying that, okay, now we have 6% or 7% of households invest in mutual funds, but 20% are in financial markets. Is this a point that we need to pause and look at other asset classes, which, all these years we have been, our mindset is to think that, equity will do well in India. But today with the market cap to GDP at 130%, is there a need to sort of temper that kind of optimism?
So there are opportunities across asset classes. So we talk about mutual fund AUM growing as a percentage of bank deposits over the last 10 years. But between 2016 and now, fixed income and money market AUM as a percentage of bank deposits has actually gone down. Bank deposits have grown faster than the fixed income and money market AUM in India. But that shouldn't have been the case. I mean, the same forces that I talked about earlier. No, it's same. It's still, it's a lot more convenient and efficient as far as mutual funds are concerned. So there are like lots of avenues for the industry to grow.
Okay. If you were to tell us, 2-3 thoughts around what is it that you wish the industry did differently? Is there anything that you feel concerned about and you wished that it changed?
No, I'm very happy that your title is Decoding Purpose, Product and Tech, right? For the conference.
Yeah.
Putting purpose ahead of everything else. This is very critical. And in the last, like in Mumbai, we discussed, this is the most noble profession in the world. This is the most noble profession in the world when you're dealing with somebody else's money. And that purpose has to be at the center of everything that we do. Client services is the only patent that an organization can have. And as far as we remain highly focused on that, everything else will fall in place. India has an incredible compounding story. You aren't seen nothing yet. We are going to be the most, how do I put it? India will create an economic miracle which is unparalleled in human history. Because our growth will be more democratic, more inclusive, more equitable, and more sustainable. Not many countries in the world have achieved something like that in this century. But I think the opportunity for us is very large. At the same time, we have to ensure that we keep building the trust of the investor, trust of the ecosystem. We get, every business gets a license to do business from the society. We have to constantly keep thinking, what is the social utility of my business? What is the social utility of my industry? And as long as I'm adding value to the society, society will give you a license to make reasonable revenue and profits and will give you the avenue for growth. I think the only one thing we have to remain focused is we don't do anything which breaks the trust of the investor. I've seen 92 bull market. I've seen 85. I've seen 92. I've seen 99, 2000. I've seen that 2007, 8. I think at various points in time, there would have been something in the capital market which led to maybe wavering of that trust. What we need to ensure this time is we don't do anything which makes trust wavering of the investors. The opportunity is so large. We've still got 5.5 crore investors. Imagine where we can be in 10 and 20 and 30 years' time in our lifetime.
True that. On that supremely optimistic note, thank you so much, Navneet. As usual, pleasure talking to you.
sir. Thank you so much, Mr. Manoj, for those inspiring insights. But requesting you to please join us on the stage for the next round of felicitations. Thanks again, ML, for guiding this discussion. But yes, now let's take a moment to honor the achievers who are shaping the culture of systematic investing and driving the innovation in the mutual fund industry. So our next recognition for the SIP champion, South Zone, for highest number of systematic transactions for PhonePe Wealth Broking. PhonePe Wealth has brought SIP investing right into the fingertips of millions, combining a seamless digital experience with a strong focus of financial inclusion, and they are the true pioneers encouraging disciplined investing and long-term wealth creation. So I'd like to invite Shiva Sai, Kiran Kumar, Sanapal and Nilesh Nayak on the stage to accept this offer. Oh, I'm so sorry. Mr. Manoj, sir, there's another round of felicitation. I'm so sorry. Right, congratulations to the entire PhonePe team on this well-deserved recognition. But yes, now it's time to recognize the emerging talent with the young achiever, South Zone, and the recognition goes to Sanjana Ramesh. Sanjana is a dynamic young professional making some remarkable strides in the mutual fund distribution. Her client-focused approach, ability to simplify financial concepts for new investors and fresh perspectives really set her apart. Thank you once again, Mr. Manoj, for doing the honors. But yes, life story is of resilience, renewal, and the spirit to begin again. A reminder that every milestone is built on the strength of perseverance. But yes, before we move on to our next session, let's take a look at how HDFC Mutual Fund celebrates the power of hard work and new beginnings.
ಈ ಜೀವನವು ಕಂತುಗಳಿಂದ ತುಂಬಿದೆ. ಉದಾಹರಣೆಗೆ ಮೊದಲ ಕಂತು ನಮ್ಮ ಭಾವನೆಗಳದ್ದು. ಈ ಕಂತು ನಿಯಂತ್ರಣದ್ದು, ಪ್ರಕೃತಿಯ ನಿಯಮಗಳದ್ದು. ಈ ಕಂತು ಒಂದು ಸಣ್ಣ ಕನಸಿನ ಆರಂಭದ್ದು. ಈ ಕಂತು ಸಣ್ಣ ಹೆಜ್ಜೆಗಳ ಉತ್ತೇಜನದ್ದು. ಈ ಕಂತು ಶ್ರಮದ್ದು, ಪರಿಶ್ರಮದ್ದು, ಬಿದ್ದು ಎದ್ದೇಳುವಂಥದ್ದು. ಮತ್ತೆ ಈ ಕಂತು ಪ್ರಾರ್ಥನೆಯದ್ದು, ಆಶೀರ್ವಾದದ್ದು. ಈ ಕಂತುಗಳು ಬೇರೆ ಏನೂ ಅಲ್ಲ, ಬರೀ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಅಲ್ವೇ? ಇದನ್ನು ನಾವೆಲ್ಲರೂ ಮಾಡುತ್ತೇವೆ, ನಮ್ಮವರ ನಾಳೆಯನ್ನು ಇನ್ನಷ್ಟು ಉತ್ತಮವಾಗಿಸಲು. ಹಾಗೆ ನೋಡಿದರೆ ನಾವೆಲ್ಲರೂ ಇನ್ವೆಸ್ಟರ್ಸ್ ಅಲ್ವೇ? ಜೀವನ ಜೀವಿಸುವ ಶೈಲಿಯೇ ಎಸ್ಐಪಿ. ಹಾಗಿರುವಾಗ ಜೀವನಕ್ಕಾಗಿ ಎಸ್ಐಪಿ ಏಕೆ ಇರಬಾರದು? ಜೀವನಕ್ಕಾಗಿ ಎಸ್ಐಪಿ. HDFC ಮ್ಯೂಚುವಲ್ ಫಂಡ್ನ ಹೂಡಿಕೆದಾರರ ಶಿಕ್ಷಣ ಮತ್ತು ಜಾಗೃತಿ ಅಭಿಯಾನ ನಮ್ಮವರಿಗಾಗಿ ಮೊದಲ ಹೆಜ್ಜೆ. ಮ್ಯೂಚುವಲ್ ಫಂಡ್ನಲ್ಲಿ ವಿನಿಯೋಜನೆಗಳು ಮಾರುಕಟ್ಟೆಯ ಅಪಾಯ ಸಾಧ್ಯತೆಗಳಿಗೆ ಬದ್ಧವಾಗಿವೆ. ಸ್ಕೀಮ್ ಸಂಬಂಧಿತ ಎಲ್ಲಾ ದಸ್ತಾವೇಜುಗಳನ್ನು ಗಮನವಿಟ್ಟು ಓದಿರಿ.
All right, now let's take a closer look at what drives investor behavior and the factors that shape long-term investing habits. India's mutual fund industry continues to break records. We've seen OM crossing 75 lakh crore rupees, almost tripling in the last 5 years, and SIP contributions have also risen to an all-time high. Clearly, India's investors are embracing this consistency and the long-term thinking. But what motivates this conviction? How do awareness, belief, and disciplined behavior combine to create sustainable investing habits? To guide us through this fascinating discussion, joining me on stage is Mr. Akhil Chaturvedi, Executive Director and Chief Business Officer of Motilal Oswal. Please give him a huge round of applause. Right, let's start with the first question. Of course, we've seen SIPs hitting all-time new highs. So what is driving this retail investor participation, and how important do you think it is for the long-term growth for the industry?
So of course, I think a lot Navneet has already spoken about, what's driving, but clearly ever since 2016, I would say over the last 10 years, more specifically after demonetization, there has been this, incremental shift, what we talk about financialization of savings, where people have been moving their assets from cash to bank and bank into mutual funds and mutual funds through SIP. So this trend of investing in mutual funds, SIPs to create wealth, I think is becoming more and more acceptable. And what I feel is that the experience of investors over the last decade has been pretty good. More specifically, over the last 5 years, broadly, investors have made good returns, right? And there is a chain effect. So as more and more people are making more money, and then there are the neighbors who are watching them, and then they are piling up. I think that is the first thing. Second, I think clearly investing in fixed income, adjusted for taxation and inflation, there is no net real return. Real estate takes away 50-60%. Largely, it is your home. Gold, of course, has done well in the last 1 year. Things are changing there, so I have different thoughts there. But people have understood that if really you want to add 3-4% to your purchasing power so that you can achieve your long-term goals, I think you can't achieve that without going into equities. And then there are certain do's and don'ts of equities. You need to be a long-term investor. You need to invest regularly. You need to go through the ups and the downs. In fact, what we have been seeing that people have understood that when you go through downs, you should double up. So you should double down on your investments. So we are not seeing, every time there's a correction, we don't see investors running away. We are seeing more investors actually coming inside or adding to their SIP book. So I think people have understood that yes, you need to have equities, whatever percentage. Some may be having 10, 20, 40, 50, whatever. Need to look at long term. And clearly investors are also seeing this whole optimism, which again Navneet was talking about, the positivity of India. We are talking about Amrit Kal in the next 25 years, developing to developed economy. As the economy will get into the developed kind of a status, there'll be enormous wealth creation which will happen out here, and I'm sure everybody wants to participate in that. So I think combination of all of these things, good experience, need for creating a lot of wealth, faith in our country, faith in our economic growth journey, all of these things I think are driving investors to move towards equities, and what better way than mutual funds.
Akhil, I'll get to the SIP stoppage ratio. It's still above 70%, and though it has come off from the peak high levels, but what is driving this investors' trend towards it? And of course, what would you say that does the short-term market swings do also shape the investor behavior? And what would you argue on this?
I think we are going through an evolution. Investors have gone through an evolution. Like I said, there was a phase when markets used to fall and we used to immediately see termination of SIPs, redemptions of from your mutual funds. But in the last 5 years, what we have seen is that incrementally, that is not what is happening. Look at current calendar year. You're talking about SIP stoppage ratio. Except for March and April, which were the only 2 months where we saw negative SIP registrations, which was, I think March was negative 11 lakhs and April was bad. It was negative 1 crore something. Every month, Jan, Feb, and then up until now, every month we have seen 14 to 15 lakh new SIP registrations. Gross SIP registrations is upwards of 40, 45 lakhs. every month, right? And stoppage is maybe about 35, 36. So you're seeing a net 14 to 15 lakhs every month. So what I'm seeing, or what we would like to see, is that net you have to be positive. Net the SIP amount has tripled, right, in the last 5-6 years. This year itself, I think we have gone, if my memory serves right, we started the year with 25,000. We are closer to 30,000 of monthly. So your net SIP in terms of amount is going upwards. Your net new registrations is going upwards. So I think the trend of what used to happen 10, 15, 20 years back, that run away when the markets go down, I think people have a lot more patience. It's not a warning signal. I get surprised every time, when there was an India-Pakistan war, I thought now things will change, right? When there was a Ukraine war, that time when the corrections happened, or election results, there have been so many instances where time and again we have tested that, the SIP book is not really coming down anytime soon. Something has to be really, really, really bad for this number to reverse.
Akhil, then where do you stand on this entire gold versus equities debate? Of course, we've had some discussions around this earlier as well. But how do you see the investor behavior shaping up? Of course, every portfolio needs to have some exposure towards gold as well, because it's a hedge. But what would you say the trends to emerge in the next couple of months? Will the investor's conviction come back to equities? How do you see this?
So conviction in equities is there, and it is growing. We are seeing that in the numbers. But yes, in the last year or so, what has happened in gold and silver clearly has, stumped everybody, including me, right? And there is a FOMO because, equities has not done anything, 0% return, and in front of that you have gold and silver, which is up 70%, 80%. So, and then we've heard all the previous panelists, speakers, everybody is saying that investors tend to chase returns, right? So over the last 3 months, more specifically, I think we are seeing a lot of demand for index funds, gold and silver ETFs. I think it's now closer to $1 billion kind of demand. In fact, ETFs were trading at premium. We didn't have gold and silver, but there was a lot of demand. But I think more from a macro perspective, with the way the current geopolitical order is shaping up, so much of uncertainty between countries and wars and so many things which are going on, I think in this kind of environment, probably I have been saying now in a lot of conferences that one needs to have a strategic allocation towards these two commodities, which is gold and silver. In any proportion, it could be 10, 15, 20%. Because broadly, you see, over the last 4-5 years, equities have done well. Now, gold and silver have done well. Real estate also has been going up. All asset classes have delivered. It's very difficult to predict what's going to happen in the next 12 months. After 12 months, we are sitting in this room and we both are talking. I don't know which asset class would have outperformed which one, right? So I don't know whether gold and silver will be on top or equity will be on top, or broadly, these are the two asset classes. So, there's no sense in double guessing this. It's time to have the principles of asset allocation to be incorporated by all our distribution partners out here in client portfolio. They should have something of everything so that after 1 year, there is no FOMO. That I didn't have gold, I didn't have silver, I didn't have equity, I didn't have this, I didn't have that. Everything should be there in a proportion basis the goals of investors.
Okay. I was going through your survey, which mentions that more than half of the Indian investors at least own one passive fund. So do you expect this trend to remain, continue gain their traction?
It's growing. I'm telling you, passives is growing. And over the last 4 or 5 years, we've been one of the active participants in this, in the passive journey. So if you look at non-Nifty, non-Sensex, or non-EPFO money, non-institution money, where passive AUM was negligible. Today it's about 3.5-4 lakh crores, probably close to that. If you see on a monthly basis, passive funds are raising almost 30% of the total equity flows, right? So if there's a lakh crore of gross flows, then we are seeing passive flows of 30,000 crores, 35,000 crores. And what's happened in the world of passive is a lot of innovation. It all began with the international funds. There was a panel on that. So all the NASDAQs and the S&P 500, they all became $1 billion fund. From there, even in terms of domestic products, like a Nifty 500, your mid-cap index, small-cap, micro-cap, and then you have variety of sectoral indices. And this whole new category which is emerging is the factor funds. quality, value, low vol, momentum, and then gold, silver, these kind of products. So passives, there used to be a lot of resistance in this crowd because I work with them. I've worked with them for over 2.5 decades. There was a lot of debate of active versus passive. Fortunately now it is about active and passive. As long as the product is unique, the product is different, it is serving certain objective or certain investor, I think that is becoming more prominent than this whole thing of active versus passive. There are many products in our house where we feel we cannot do a good job in active, we do passive, right? So where we feel we cannot provide alpha, we give beta, right? And where we feel we can give alpha, we launch active products.
Okay, but we did see in the month of September that mid and small cap funds have the inflows in there have seen highest inflows. But if you look at thematic funds, the inflows have moderated. So how do you juxtapose this, growth versus thematic bets argument?
So thematics typically thematics tend to do very, very well in very, very tailwinded markets. When markets are really roaring and the returns are like 20, 30, 40%, that is the time investors' risk appetite really, hits the roof. And those are the times when sectoral funds and thematic funds really get into the vogue. Obviously last 12 months have not been very kind for the market, so we've seen the slowdown of flows in the thematic side. I think whatever flows we are seeing on thematic is the bunch of few NFOs which have happened. But I would say that thematics have their own place in the fund manager panel. When we were hearing them, I think they spoke that defense is a good long-term theme or consumption is a good medium to long-term theme. And so apart from your diversified portfolios, if you believe in 2 or 3 very big opportunities in terms of themes, there's no harm actually to participate in those themes, whether it's manufacturing, consumption, whether it is defense or whatever it may be. But yeah, these kind of markets, probably thematics and sectorals will slow down. And in very, very bullish markets, risk appetite is very high. That time, these funds, last year we've seen the numbers, right? Yeah. Crazy numbers.
Okay, so you have some products in the alternate space as well. So how do you see the trends going from here? And of course, how do they stack up against the traditional mutual fund products that you have?
So alternates have been, on a lower base, alternates have been growing at a higher compounding or higher percentage. The rate of growth for alternates have been higher compared to mutual funds. Obviously, because they are young, they are small, so the growth rates will be far higher. But I think with over 400 portfolio management services, and I think over 20, 25 AIFs, what we are seeing in the mass affluent, high net worth, super HNI, family office segment is clearly they want new ideas. They want products which are different compared to plain vanilla mutual funds like a large cap, mid cap, flexi cap, all of those things. So, and they have enough money to take enough risk, right? On a portfolio of, somebody is having a portfolio of 10 crores or 50 crores or 100 crores, is okay to invest, let's say 25, 30, 40% in alternates as long as the product is different. And if you see the stats in terms of just look at AIFs, and you see category 1 and category 2 is actually dominating, which is the unlisted, real estate, venture capital, all of these spaces, alternates. That's like 10 lakh crores out of 12 lakh crores of total AIF AUM. Cat 3 is about 2 odd lakh crores. So there is a huge demand for, these days there's a huge demand for unlisted. There is a huge demand for pre-IPOs. Even retail investors are actually buying, unlisted stocks, etc. Everybody, if you want to participate into real estate, it's not that you keep buying homes all the time. You can simply, put a small amount into a AIF and participate through a organized way. Private credit, so alternate to if you want high yields from fixed income, which is not possible in mutual funds nowadays. The high net worth is moving towards private credit. They are moving, like I spoke about, real estate or investment, high yield infrastructure funds, so on and so forth. So I think there is a big space, and at the pace the rich Indians are growing, I think we have now 1.5 million Indians who have $1 million and more of net worth, right? So this this part of population is growing at a very fast pace, and this is where the demand is coming for alternates. And so we feel that, yes, this is going to be a very interesting space, including now SIF, what has been launched, which is another new asset class which has got created. So I think this is going to be a very interesting space to watch out.
Looking ahead, if we look to take a look at the larger picture, what do you think the 3 factors are going to shape the investor's decision from a long-term perspective?
Sorry, I missed the first part.
The 3 factors that will shape the investor's decisions going ahead.
I think, I don't know about 3, but I think overall conviction, confidence into our economy, what's looking forward. I think, typically how the flow trends are shaping up. Obviously, over a period of time, how the returns also shape up also plays a very, very important part. So I think as long as there is an optimism about growth going forward, we will see that investors will be excited and will try to seize every opportunity to participate in the growth which is looking forward.
Okay. Just one last question from the vantage point of a relatively new AMC. How do you see industry growth and the participation going ahead?
From our perspective?
Yeah.
No, so all of them out here have been very kind. I think we've been one of the fastest growing new AMCs. So we've grown like almost 47, 48 times. See, I think that asset management companies, especially the newer ones or those who intend to come now, have to work really very hard to position themselves and create a value proposition which is very different from what is existing in the market space. Only then will we see interest coming into those kind of AMCs, right? So the positioning, what kind of value proposition you're offering, what kind of products, what is your philosophy, processes, there has to be something different for somebody to really look at you. That is what we tried, and a few of our, some of the new AMCs which have been very, very successful, all of them have positioned very, very differently. All of them are offering different philosophy, different styles, different products, and that is what is, creating this momentum of flows. It's not only that now the larger AMCs are growing. In fact, the smaller AMCs or the mid-level AMCs are growing at faster pace than the larger AMCs.
All right, we'll keep that in mind. But yes, thank you, Akhil. Thank you so much for this conversation.
Thank you so much. Thank you so much.
Thank you, Mr. Chaturvedi, for sharing such valuable insights as well. But let's shift focus to our next discussion, which is your technology, which is truly transforming the finance in India. From $584 billion in 2022, the Fintech market is projected to hit $1.5 trillion by the end of this year, which is powered by digital payments, online investing, and app-based advisory platforms. Now, this is creating a massive opportunity for mutual funds to scale responsibly and reach a wider universe of investors than ever before. To explore how technology is shaping the future of investing and driving inclusion, we have Mahalakshmi back to moderate this exciting conversation. We're also joined by leading experts who are at the forefront of the innovation in the industry, inviting back on the stage Mr. Navneet Manod, MD and CEO of HDFC AMC. Vishal Jain, CEO of Zerodha Fund House. And Sandeep Chetwani, co-founder of Decode. Please welcome them with a warm round of applause.
Thank you, Alisha. So this is the most exciting part, especially since we are doing this conversation in Bangalore. We couldn't not have a session on technology. And actually, I'm really glad for the three people here, because this is as diverse as it can get for the mutual fund industry, right? We have, the most trusted mutual fund, if I may say. I mean, one or two contenders may sort of say that's not, you can't say most trusted, but Indeed, HDFC is a very, very trusted brand. All of us, I think, a generation bought their first homes with HDFC loans. And in the AMC business, of course, they've done phenomenally well. It's a household name. And then we have a new AMC whose parent redefined a business, came from nowhere and became a leader by a margin. And then we have somebody who is working on technology, a very important part of this mutual fund ecosystem, which is advisors using technology. So a legacy player, a challenger, and an intermediary. So let me start with Sandeep first. In the last 5 years, like we were talking to, like I was talking to Navneet earlier, there is this pre-COVID era and the post-COVID era even for mutual funds. And we've seen this industry really transform. And there are multiple factors, investor behavior, ease of technology, ease of onboarding and stuff like that. What is, if you were to just carve out, what is the role of technology in creating this growth?
Mahalakshmi, thank you for having me. I think if you look at, we're talking about the mutual fund industry here, nearly 75, 80 lakh crores. And they've done a lot of great work in coming to this point. They've leveraged access. They've given access to everyone to be able to participate in the markets. There is an efficient mechanism to participate, courtesy of the lower costs and savings that mutual funds bring. I think now technology has a big role to play in the third aspect of it, which is the trust, which is hand-holding individuals to come into the right mutual funds. I think we are extremely convinced that mutual fund sahi hai, sabke liye sahi hai. Now, kaun sa sahi hai, and holding people and hand-holding them in that journey is, I think, the important part. Today, there are nearly 1,800 odd schemes to choose out of. I think technology has a big role now for us to help people figure out what is the right combination of portfolios that they can have within this. And it now allows, courtesy of account aggregator, for us to be able to see their existing portfolio, advise them on suitability, advise them on what is the right time for them to invest. We were hearing about the longevity of investments. I think if you are able to reflect data in a transparent way, it actually encourages that longevity to happen. So I think technology now has to play the role of trust building for the industry. I think when I think about the mutual fund industry and you benchmark it to global benchmarks, there is at least about a 5x runway from current GDP levels for us to go to. And then if the GDP expands, there's much more. The hand-holding portion has a much longer runway. It's a 10x in terms of growth that the wealth management industry can see from here. So I think that's where taking hand-holding down to the last Indian is, I think, the role of technology now.
Right, well said. The question is how, and we'll come to that. But before that, Vishal, when all these new AMCs like yourself came in a few years back, there was quite some excitement that, especially when a name like Zerodha comes or a Geo comes, the feeling is that these guys are going to redefine the market. So why haven't you toppled HDFC yet? Or is this a business that cannot be redefined so easily because we have stalwart players?
I mean, we're still too early in the game, Mahalakshmi. I mean, see, asset management is it's a 5-day cricket match. Yeah? It's not a, IPL or something like that.
Okay, so where are we in that match?
Oh, we're still at a very nascent stage. I mean, to topple HDFC would take us years and years. But I think that one of the reasons why, we started the MF was we felt that a lot could be done to kind of simplify the process. And therefore, one of the reasons why, we feel that, at this point of time, when you look at penetration is now hitting at about 4% or so. And, if we keep talking about, Vikshit Bharat in the next 20 years, if a large portion of our population does not start investing in financial products, then we won't reach there. At this point of time, we're at about 5.7 crore, unique PAN folios. We need at least 30, 40 crore more people coming into the mutual fund industry. And therefore, I think that, there are many ways through which this can happen. I mean, all modes of distribution is something that will help us reach that number. But when you look at India as a country, I mean, the biggest problem that India has is the sheer number of people that you have. And it's only technology that can help you reach out to, those many people in terms of having simplified processes, having simple products, having simple journeys, and basically talking in a very, dumbed down manner to be able to get more and more people to kind of start using mutual fund products.
Sure. Navneet, so, from the vantage point that you are sitting in, what do you think is the role of technology in accelerating growth or scaling this whole industry? Because sitting in Bangalore, we all, even sitting in Bombay, I mean, we're always excited about technology, redefining so many things, right? But when you start to think about it, portion by portion, there are some things that just take time, and definitely the investment industry is not something that you can sort of, it's not like a speed game, or it's just not about onboarding a lot of people. It's not just about a lot of things that perhaps worked for broking. Realistically speaking, what is the role of technology and where does it take us from here?
So first of all, thank you for calling us the most trusted brand and the most trusted AMC. And always say that size and stability doesn't guarantee you that trust. Over a period, you also need to ensure, apart from the fact that you need to be purpose-driven, you need to be nimble and agile, because market environment is constantly evolving, it's constantly changing, and you have to adapt to the new reality, and that is what the group has done. Technology has played a very big role in the growth of our industry. And if we'll go back like 35 years, so I started with and saw the open outcry system, and we moved to like online trading. What a transformation it was. Very difficult to even explain to you what a change it was. We saw like physical certificates to dematerialization. What a technological transformation that was. We moved from undefined settlement cycle to like T+1. We moved from Vyaj Badla to like F&O. There has been like constant technological innovation in India. One of the biggest things that's happening in India is you have a large population, 1.4 billion people, who are digitally enabled, digitally savvy, but financially underserved, which is like a tremendous opportunity for many players like us. You have a population which is digitally enabled and digitally empowered, and they are financially underserved. On that, with a sense of purpose, what Prime Minister did in 2014 was the Jan Dhan Yojana. After several decades of bank nationalization and many other efforts, we couldn't get like even half the population having a basic bank account. And from there, we moved on to like almost 100% coverage. And in fact, then we have leapfrogged with the digital public infrastructure that almost everybody has got, a bank in the mobile phone with the UPI, other things. And I think the next leg is you build the identity layer, then you've got the bank account and the UPI, and on top of that, you can build like many services, and on that like investment is like one very big need of large number of investors that we can meet thanks to the power of technology, which otherwise wouldn't have been possible. Like earlier I mentioned that number of investors at our end has doubled in last 2 years. We went from 65 lakhs to like 1.4 crores now. That wouldn't have been possible without the power of technology. Half of our transactions used to get done physically. Now 96% of our transactions get done digitally. And now, we have opened 50 more branches in last 2 years. I still believe that human connect and the warmth of people is very important. But at the same time, transactions get done digitally, information get passed on digitally, your operational efficiency, your compliance, your investment management, and of course the client engagement, partner engagement happens through the technology. So it's playing a very big role. And now with the advent of AI, I think possibilities are endless.
Sure, we'll come to AI. But before that, Sandeep, you said in the next phase, through digital, building trust will be vital. How do you do that?
Mahalakshmi, if you look at the role of technology here, I think if you break it up into two parts, the tangible and the intangible. The tangible is spoken about a lot. There is easier KYC, there is easier account opening, there is the digital public infrastructure, which is the account aggregator platforms, the UPI to enable transfer of money and so on. I think now the role of technology in building trust is with the intangible side. I'll give you an example. Today, sitting out of 5 offices in India, we are serving 250 locations all over where portfolio management clients are onboarding onto our platform. How is that happening? These are individuals who are engaging with us on video calls. That again is a new concept for most people. How do you invest a princely sum of 50 lakhs or more with somebody you haven't ever met? And how has technology helped there? The fact that when you wire your money to a portfolio manager, a custodian will handle it for you. It will be safely reported back to you. There is a platform on which you can see the report very transparently. So I think there is a lot of intangible work that we are able to do as a result of India's digital public infrastructure, some of the investments that we are making in the user experience, which in turn is helping trust build. And once trust builds, then it compounds from there.
Vishal, going back to Zerodha, when you launched, I mean, the genesis of Zerodha was that itne sare rode the for anybody to go into broking. So the term Zerodha itself was to make Rhoda's zero. So when you launched the fund, was there anything that you saw was missing and could be a game changer because of technology? And has it really played out? Why not?
I mean, when I look back, if you look at and I don't know, maybe Navneet can second this as well. If you looked at the first, bunch of private sector mutual funds which came, say, in 1995 or so, I think the first 20 years, most of the focus was on getting AUMs. And typically, AUMs came from the institutional business, a large part of it. I think from 2015 onwards till now, I think a lot has come through HNIs. So you now have the evolved investors who are there in the market who are investing in mutual funds. It's only in recent times that we've seen the uptick in folios kind of really sharply increasing. So we're adding, I think, if I'm right, about 1 crore new folios, a year. And in total, if you look, we are 5.7 crores over the last 30 years, right? And now we're adding about 1 crore folios a year, new folios. We feel that this can be paced, can happen much faster. And we think that that's something that, a brand like Zerodha can kind of help because of the digital infrastructure, the digital know-how that we have and that we bring on the table. We feel that we can kind of help in getting more and more people to start investing, small ticket amounts into financial products.
Sure. But then, the small ticket one, I mean, several new funds launched it, but it's not really taken off, right?
I mean, it's still, you need to see it in perspective, Mahalakshmi, in the sense that, look at, okay, I can talk about kind of passive investing because it's something which is a space which is very close to me. If you look at the year 2020, the total AUMs in ETFs were about 1.5 lakh crore. And there were about 20 lakh investors who were there. Today, that's become 2 crore in 5 years. And the AUM is now 9.5 lakh crores in ETFs, or even more as of now. When you look at stuff like index funds, there were only about 5 lakh investors in March 2020. Today, that's 1.2 crore. So when you look at the growth, you need to kind of see it in perspective. The last 5 years, there has been a huge uptick, not only in passive, but across the industry as well.
No, I was more referring to small ticket size investments. Like, for example, this Choti SIP that has come through. Even that in the first phase has not really, we launched it with great enthusiasm, but it's not something that is really scaled. Is that a viability issue? Is that a selling issue? Is that a technology issue? What do you think is missing, and how can we cover that with technology?
The numbers have been increasing, may not be in the Chota SIP, which again, industry is working very hard that how do we make that more popular, and if there are any anything that needs to be done on that front. But some of the fund houses like ours, we already have minimum ticket size at 100 rupees, at 100 rupees per month. And some of the other fund houses have also got that. And yeah, there are investors who can access the market with amount as low as that. And again, going back to the same point, without technology that wouldn't have been possible. The cost structure wouldn't have allowed you. I think still there is a lot more that needs to be done to bring down the cost of KYC, to bring down the cost of like overall onboarding of the investors, and the efforts are on that front.
Okay, so it's more a cost issue you're saying, or the investor journey, how does that happen? How do you sell? How do you get
many things at play for variety of reasons. As I mentioned earlier, for decades we could not provide like a bank account to everyone, and then when several things got made easier, the same thing is with the telecom penetration, right? I think the ease of KYC and some of those things led to millions joining the mobile phone revolution within few months. What could not be done for years before.
Right, Sandeep, is that even an area of priority for you at your company? If at all, what needs to be done to get that population of the market excited about it? And of course, with the guardrail that the right product needs to get sold, because that is fundamental.
Lakshmi, I'll answer the question from Deserve's point of view. The first is that we are still in the journey of building trust. You said the most trusted AMC is sitting here. We have to traverse that journey in the time forward. And when we do that, we start with a certain segment of clients. And then we, over time, be able to demonstrate value to more people. That is one part. The second part is to be able to enable people to come into this ecosystem in a handheld manner. There potentially needs to be a reduction of cost of execution of every transaction. And India is going through that journey. Today we have between 35 to 40 crore individuals using UPI, right? Going back in time, the cost of doing a 100 rupee transaction online was very high. Today it is much, much, much lower. And therefore this is happening. I think as some of those benefits come into the investing ecosystem, companies like us will be able to serve in a handheld manner more Indians. So I think it's both a journey of where we are at and the intersection of where the country's infrastructure on the digital side will get to.
Fair enough. Navneet, if you were to have, call out one digital lever that you think can be transformative for HDFC AMC or a player like you, what would that be? Is there anything that you wish for or working towards?
I think for almost everyone, AI is transformational. What you can do in terms of on the investor education and awareness, on personalization at scale, what you can do on your operational efficiency, on using the RegTech for a lot more efficiency on the compliance side, whether in terms of, I think almost on all aspects, there are immense potential of like how to leverage AI and do many things possible, yeah.
Okay. Vishal, is there anything that is unique that you are building in terms of making the investor journey better or, making them more informed about their investment choices, bettering their investor behavior? Anything that Zerodha is working on uniquely?
So one of the, important initiatives that we took was, to build an entire journey on WhatsApp. Because we felt that, what are those few platforms, through which investors are already there or people are accessing those platforms. So the whole objective being that without somebody having to download another app or go onto another website, can we kind of use platforms to be able to kind of come closer to the investor. So WhatsApp is a journey that we kind of, worked on for the last 1.5 years. And this was something that we've done completely internally within the organization. It's something that has already gone through 3 different versions. And we're quite excited about, a kind of a platform like that, because just with about 2 or 3 clicks, you can actually just start an SIP or invest in a fund or track your investments in just one place. So these are some of the initiatives which we're taking. There will be many more initiatives or innovations that we're working on the distribution side that we hope to see in the next, couple of months, which will come out.
Right. Sandeep, how do you see these digital journeys actually working out? Because I asked this question because a lot of companies in India, which are digital native e-commerce space, insurance sellers, all of them initially started with these digital journeys and then realized that, it doesn't scale beyond a point. You need a blended model or an omni-channel to support it. Do you think we are ready for a completely digital sort of sales setup?
I think, Mahalakshmi, the focus of any industry is the client or the customer that you serve. When you think about India's wealth creators, there are people engaging with financial products in different ways. There are people who are preferring digital journeys or are sometimes forced into digital journeys because they don't have access. And there are sometimes people who prefer to be in touch with human beings and meet people and touch and feel. I think we have to be where the client is. In that sense, we have to shape our journeys such that clients relate with us. And this trend you've seen, people start with one channel and effectively then later become omni-channel, I think is the journey of getting closer to the end client. I think, and here, there is an evolution of the client that is also happening as we go along. One of the most active users of, let's say, WhatsApp is probably the older generation, right? They are power users, right? And going back 20 years, if you were to tell my dad that he would be primarily interacting with his friends and network on WhatsApp, it wouldn't make sense to us, right? But today, that has changed. And that is something that we believe will happen when it comes to financial markets or engagement with people's own money. And we are seeing early signs of that.
Navneet, what is the role of AI? What do you think could be the role of AI in sort of furthering investor education from a, AMC's perspective, client communications and stuff like that? Do you think AI advice is a good idea at all? Are we at this stage? Because I know it's a little premature to ask this question, but I think in just a few months, this is going to be a reality.
Yeah, I think the bigger gain is to reach out to a much larger number of investors and think of scale by using the AI. For example, a bot which can answer any number of people simultaneously on any questions related to your products, or a client services bot which can answer the query instantly on anything pertaining to regulation, anything pertaining to any particular aspect, and also dealing with large amount of data wherever you do that. And so every organization has got structured data, but there's so much of unstructured data which is available, and making sense of all of that, there is tremendous potential for everyone to get a lot more smart on using the data and the analytics and using that at scale.
True.
I think the biggest thing is that when we send an email today to, let's say, all our partners, it's more or less similar, regardless of, let's say, their background. But what you can do is you can personalize to each and every one. Yeah.
True. These are all definitely desirable features. But Sandeep, do you worry about AI advice coming and completely disrupting your model or any distribution model? And I'm asking this question, it might sound a little funny, but I'm bowled over by the fact that you can put your groceries on ChatGPT and it could be a reality that it'll order and you will have your groceries at home, through GPT. I mean, who could have imagined even 1 month ago? So if you could buy, say, I am XYZ, this is my income, this is my, situation, and please tell me the best funds and also buy it for me.
Mahalakshmi, not in the way we want it, but AI advice is already here. Clients are uploading brokerage statements, mutual fund statements, etc. on ChatGPT, Gemini, Grok already. And they're already taking guidance from there. Right? Now, whether they're acting on it, I don't know. Right? But I think AI will have potentially the exact opposite effect, to my mind, of what we are all anticipating, which is the Jeffson's paradox playing out. What does that mean? As AI enables, like Navneet was saying, companies to become more efficient, RMs to be enabled more, the institutional memory of a client to become stronger. There will be more RMs required, not less. And why is that? Because you will be able to serve individuals with lower ticket sizes. Today it is expensive to serve somebody with, let's say, 1 or 2 lakh rupees of investments and provide them holistic financial advice. But imagine a world where AI makes companies like us much more efficient. It enables us to track the communication of RMs. It enables us to ensure that there is no mis-selling happening. In that world, for us to be able to serve many more individuals will become possible. And at that point, I think the value for human engagement will become much, much more. So I am actually optimistic about how AI can enable human advice to propagate further.
Sure. Quickly.
Can I add? So I remember when internet came, like in 90s, when it became more pervasive, a lot of people said that business travel would go down because people will have the video conferencing. But that didn't happen. Business travel actually increased so much. Same thing with the YouTube and all. People thought that lesser number of people will go to concert. The concert economy is at an all-time high and it's likely to grow even more. I think the more the technology, the need for people interaction is not going to go down as long as humanity is alive. The more you are with the machine, the more you will feel the need for a human interaction.
Absolutely, and I hope that happens. I hope that wish and pray and hope.
Several times I get asked that, will distributors get disrupted by the AI? Like as you said, that somebody will create a portfolio. But when the market goes down 4%, you need a shoulder. And that's where the role of the distributor or advisor would be.
And ChatGPT won't take shouting from a client very easily, right? So we are standing for that.
True. On that note, thank you so much. That's all the time we have this evening. Thank you so much, gentlemen.
Right. Thank you to our esteemed panelists for that future-forward conversation on technology, scale, and inclusion. And a big thanks for ML, too, for moderating as well. But yes, in today's fast-evolving landscape, technology is rewriting the rules of distribution, from how investors are onboarded to how engagement, compliance, and transparency are delivered. It's about using smart tools to reach the next generation of investors faster and more efficiently. So to explore this conversation further, please welcome Senthil Gunashekaran, Chief Business Development Officer, India and Global Business, KFin Technologies. Please give him a huge round of applause. I'll start with the first question, Senthil. I mean, mutual fund distribution has changed in the last 5 years more than in the last 20 years. So what do you think is driving this acceleration? Is it regulation, technology, or investor behavior?
First of all, thanks Moneycontrol team for giving us an opportunity. I am the outlier in the entire panelists who spoke before, because most of them from the asset management industry and we are the only service provider. So just to answer your question, many things have been spoken by the previous panel in terms of technology. So I'll not dwell too much on the technology part. See, as we see today's current statistics, there are close to about 1.7 lakh distributors in the country, in excess of 1.7 lakh distributors. And if you see, these distributors are not coming from top 8 metros. 50% of the distributors are coming from B30 cities. And today, if you see, the investors are coming across 19,000 pin codes across India. So it is not polarized towards top metros. It is very, very diversified across the strata of the society. And the important aspect to look at is like what the industry has seen. Like today, we are at like close to about 5.7 crore unique investors across the industry. Of this 5.7 crore investors, like 50% of the investors have come in the last 4 or 5 years. What the industry has seen over the last 40 years has happened over the last 4 years. And the interesting statistics is 70% of these investors who have come in are all less than 30 years of age. So which means definitely the investor interest is there, investor behavior has changed, and definitely technology is playing an important role. I would not say like whether regulation, technology, or investor preferences is going to determine. It's a confluence of all three factors which will determine the growth of this industry. Just to add on to that, like today, just before this panel, Navneet also talked about digital disruption. One thing I just want to talk about is in terms of digital maturity, which is digital adoption. If you see in this industry, as we speak, the digital maturity, we are still lagging behind our peers, especially banking or insurance or even retail. We are still 10 years behind in terms of what banking was, what retail was. But in terms of digital adoption, like the entire industry, like Navneet mentioned, HDFC has 96% of the transactions are happening digital. Whereas even if you take the entire industry, close to about 90% of the incremental transactions are happening through digital. So that shows the importance of technology. To answer to your question, yes, it's a confluence of all three factors which will determine the growth of this industry.
Confluence of all three factors. But if you have to look at the most transformative technologies, so what are those which are shaping the fund distribution? Is it going to be AI, APIs, data analytics? What do you see?
See, it again depends on different segments. Let me answer this question in two levers. One is the distribution community, another one is the asset management. These are the two levers which are driving the industry growth. If we talk about distribution, distribution also has different areas. Like one is the MFDs, which are catering to larger distribution community. Their requirements are completely different from a wealth management outfit or a family office. For example, today, for a mutual fund distributors, which we talked about, 1.7 lakh distributors, very few have access to technology tools. So that's why, like what service providers like us, we have created platforms for these MFDs, where it's a multi-asset class platform, where if a distributor, beyond mutual funds, if you want to transact in NPS, if you want to transact in AAF, PMS, there is an aggregated platform which has been created for these MFDs. Secondly, it's the next segment of the distributors, which is the banks, the national distributors, boutique wealth outfits. Their requirements are completely different from what the normal MFD would look at. Today, advanced analytics has become a core point of discussion, especially with the boutique wealth outfits. So when I say advanced analytics, I would bucket it into 4 different buckets. One is the descriptive analytics. So when I say descriptive analytics, it talks about your portfolio performance, relative performance, your correlation with other asset classes, cross-correlation. All these things are descriptive analytics. The second bucket is the diagnostic analytics in terms of your compliance, limit monitoring, whether it's a security level, stock level. When you see at an aggregate portfolio level, how are you able to dissect the portfolio? That is one. And second, in terms of one thing which is being ignored in the industry, especially in the wealth management, is the risk analytics. Whether it is portfolio attribution, whether it is risk attribution, return attribution, or even value at risk analysis is not being widely used. So that is the diagnostic analytic. The third one is in terms of the predictive analytics, which is catching up globally, and even in India, there are various platform providers which are providing predictive analytics in terms of stress testing your portfolios, using various scenario analysis, and also having various tailored portfolios and bundled portfolios to meet the needs of investors. And the last segment is the family offices, which is single family offices or multi-family offices. Their requirements are completely different. So they are catering to global portfolios. So you need a multi-currency platform to cater to their needs. Portfolio aggregation across countries, across geographies is very, very important. So definitely all these things are very, very relevant for distribution community. And the second lever is the asset management companies. When I started my journey 20 years back in asset management, there were close to about 44 odd AMCs. Even still, we have close to about 44 odd AMCs. But the trend is changing. Today, if you see, at least a dozen of new AMCs are likely to get launched in the next 6 months. So whether they will have the might to spend on technology, today compliance, today if you take asset management industry, there are close to about 800 odd headline compliances which needs to be met. Whether it is operational compliance, whether it is technology compliance, whether it is investment compliance, investor compliance, there are umpteen number of compliances that needs to be met. For a new startup AMC, do they have the wherewithal to have this compliance monitoring platform? So these are certain things which we have created as a part of the new AMCs. So definitely the tech stack for distribution community is different. Tech stack for asset management is different. So we are catering across the spectrum.
Okay, let's talk more about Ignite then. Because it has been faced as the next catalyst for the growth in the distribution phase. So how does this initiative reflect your approach to empowering and future-proofing the distributors?
See, one thing, Labisha, is like, I come from an asset management background. So I know the importance of distributors. So what we thought is like, since we have been adding more and more new asset management companies into our kitty, what we realized is distribution is one community which has been ignored by the service providers. So we thought like we need to have a dedicated program for the distributors. So that's why this Ignite was launched. And this Ignite as a program was something which was not sat in the boardroom and decided among ourselves. So we reached out to hundreds of distributors across the country, identified what their problems are, and this entire program is structured in such a way that it caters to whatever the digital tools, what are the technology tools which are required for a distributor, the different sets of distributors which I spoke about. So all those things have been curated. Secondly, in terms of having dedicated relationship managers to cater to the needs of distribution community from a service provider angle is also been thought through, and we have created that. And today, like as a RTA, we are sitting on petabytes of data, and every distributor needs some data through APIs on a real-time basis to provide portfolio insights to their clients. Is this data available? So how efficiently we can transfer this data to the distributors? This data transfer and data transmission is something which we have thought through, and we have created some solutions. And lastly, in terms of training programs for distributors, which is also very, very critical. So now, the first panel talked about SIFs. So SIFs have become very critical. But for distributors to empanel themselves to sell SIFs, you need to clear the NISM exams. So we have been helping the distributor community in terms of training distributors across geographies, in terms of clearing these SIFs. So Ignite as a program is not a approach for just providing tech solutions, a unified approach for the distribution community.
Okay, but how does it help distributors and strengthen their business capabilities going ahead, the Ignite?
See, the previous panel talked about hyper-personalization. Today we are living in the world of digital transformation. So if in case, see, today the major risk what a distributor faces is not the credit risk, it's not the market risk, it's not the liquidity risk. The important risk what the distributor is facing is the investor attrition risk. So how do you curb the investor attrition risk? To curb the investor attrition risk, you need to have hyper-personalization, because as an MFD, you are competing with the largest of the wealth management outfits. You are competing with the best of tech platforms in the country. So how do you facilitate these to the smallest of the distributors is what the program is all about. And we have created various digital tools and tech solutions for wider range of MFDs to benefit, to reach out to this hyper-personalization and digital hyper-scalability.
Okay, just one last question. If you had to bet on the next-gen capability that will redefine distribution in the next 5 years, then what would it be and why?
See, definitely many things have been talked about AI. I think AI is one which is going to disrupt the service industry, at least like in terms of customer service and client service experience. So Navneet also talked about chatbots and all those things. We are already developing all those things. So this is one industry which is high touch with high tech. So tech cannot replace the human intervention. So it will be an always combination of high tech and high touch. So we are just building various capabilities around that.
All right. Thank you, Senthil. Thank you, Senthil, for this conversation. And of course, how technology is shaping up the distribution business.
Thank you.
Thank you, Mr. Gunashekharan, for those sharp insights. And now we move on to our final set of felicitations, celebrating leadership and innovation in the world of investing. To do the honors, may I please invite on stage Navneet Manod, MD and CEO, HDFC AMC. With a big round of applause. All right, our next recognition is the Women in Distribution or Nari Shakti South Zone for total AUM for Savini Wealth. Led by visionary women, Savini Wealth is transforming wealth management in South India. Their dedication to helping families achieve financial freedom through ethical and strategic investments. Moving on, our last category of the evening is Fintech Partner of the Year for highest AUM edition. The recognition goes to Zerodha. I'd like to invite Nilesh Verma to join us on the stage to accept them. By combining the innovation, education and technology, Zerodha has made mutual fund investing seamless for millions of investors. Thank you, Mr. Manod, for doing the honors, and congratulations to all the winners tonight. Well, what an incredible evening it has been, from product innovation, purposeful investing, to digital transformation and technology-driven scale. Every session has shown just how dynamic India's mutual fund ecosystem truly is. A heartfelt thank you to all our speakers, moderators and award winners, and to our partners, HDFC Mutual Fund, Axis Mutual Fund, KFin Technologies, Mirae Asset Mutual Fund, Motilal Oswal Mutual Fund, and Reliance Industries for making this summit a resounding success. Thank you, Bengaluru, for your enthusiasm and energy. Until we meet again, let's keep investing and keep building bigger and better with the power of innovation and invention. Let's all proceed towards dinner. Good night and take care.